found is that in the past, when we tried this, some folks work really well at home and others really struggle with it. And so we've been really setting up a lot of remote tools, Slack, Zoom, video conferencing, conference calls. We have daily stand-ups, and we're looking for what are the daily metrics that we expect to get done for the day, and are they actually happening?
You also had a big global conference call with your CEOs that you're on this big group with. What are the CEOs in Italy telling you about preparing for this?
Yeah, great question. This was I'm part of EO International, which is an entrepreneurs organization, and they had a conference call with the leadership in Italy, and the message was get ready, it's coming, and it's likely what's going to happen here is going to look completely different from what we have right now in 2 weeks.
All right, so that's Marty. So you can tell that my Skype skills need a little help here, but if this is the new reality of working from home, I'm going to work on that. Morgan?
I don't know. I'm pretty impressed, Contessa. Thank you for bringing us that.
Thank you.
The amount of Zoom invites my family has gotten for school and everything else, it's through the roof. All right, Contessa Brewer. Let's turn back to this morning's massive drop in stocks, though, specifically those in tech. RBC's Mark Mahaney and Krish Sankar of Cowen join us now. Good morning to you both. Krish, I'll start with you. Specifically, Apple. We have spent the better part of this year talking about the China impact as we saw coronavirus affect that country on Apple, where that country is concerned. But now that you have retail stores there opening back up, but retail stores in the rest of the world for Apple closing, what does that impact look like?
Sure, Morgan. Thanks for having me. And it's a very good question. I would say a month ago, when this whole thing started and Apple pre-announcing on President's Day, it was largely China, tied to China, and more importantly on the supply chain. And what you have seen over the last 1 month is the supply chain in China is actually coming up to speed, with our fieldwork suggesting that, the utilization rates are about 50% compared to 25% a month ago. And they're trending towards getting to 90 to 100% by end of the month, which is a positive. So now the focus shifts to demand. And like you rightly pointed out, the concern with the supply chain last month was demand in China. And now it's slowly expanding to demand in the Western world. And we think there will definitely be impact on that. It's very hard to quantify it today where we are sitting. But when we did an analysis, we tried different scenarios looking at current consensus numbers all the way to down 3% year for Apple, assuming, the global demand gets impacted, especially on the hardware side because of the virus.
Yeah, I mean, to that point, Krish, and it's something that I keep coming back to, but is there any way to get your arms around what that demand picture could look like for things like our iPhones and other luxury electronics that Apple is so well known for? I ask that because if people are losing their jobs or they're foregoing paychecks, maybe they're not feeling so confident, we see the economy go into recession, are they going to be as willing to spend that money or move into another upgrade cycle?
Very valid point, and it is a tough one to answer, but one thing I would say is that the way we looked at it was, prior to this whole virus situation, I think the iPhone unit numbers were tracking north of 200 million for calendar 20. And now we are assuming a worst-case scenario if it goes down to around 180, 185 million units, which would probably trigger right around a replacement demand level, because if you look at the install base of iPhones, just around 1 billion units, maybe shy of 1 billion units, and in a 5-year replacement cycle, it implies 200 million units per year. So at 185 million units, you're just below what I would characterize as the replacement unit level. So anything else beyond that would suggest to you, people prolonging. So in other words, if Apple ends up shipping close to 185 million units, it's down from what it was pre-virus, but it does assume there is a certain amount of replacement demand happening. Anything below that, I would say, below 185 million units, it implies people are holding out and not willing to switch phones at this time.
Krish, along those lines, how are you modeling Europe? Because I'm thinking not just about Apple. I'm thinking, for example, about Huawei, which is doing a lot of business in Europe on handsets on the consumer side. And when you've got not just Italy, but also Spain and France starting to place all kinds of restrictions on what kinds of stores are open, how people can shop, I'm not sure there's enough delivery available for people to buy phones and equipment, even if they wanted to still buy them at a time like this when there are such concerns. So how much reduction in demand for electronics in general, maybe Apple specifically, are you modeling, and how long do you expect that demand to be suppressed?
Sure. So I think on Apple, I would say that overall right now, like I said, we had originally like 202 million units for iPhone this year. They've gone all the way down to 185 million, give or take. So that's like roughly like a 10% cut. On Huawei, I think Huawei is slightly different because the reason is, John, you have a very valid point. They do have some share in Europe, but I would say that ever since the U.S.-China trade wars last summer or 2 years ago it started, and the ban on Huawei since last June, I think some of the demand in Europe has waned. Huawei largely is a China-only brand today. Or I would say more than 70% of their units goes into the China market. So I think from that standpoint, they're probably slightly insulated. But I think to your point, I think it's more a question of Apple and the other brands which might have an impact from Europe. But right now, we're assuming a 10% haircut to iPhone units. And also keep in mind, this assumes that demand does slowly start coming back in the second half, and calendar Q2 numbers are going to be really weak, and I think the stocks are already discounting that. We have to take it on a month-by-month basis to see if the demand collapses beyond Q3 or Q4.
Krish, finally, balance sheet health. I imagine Apple's in a league of their own, but beyond that, who's at the top?
Absolutely. I mean, that is one good thing for Apple, solid balance sheet. I think the cash flow should still be strong. It's kind of interesting. Last week we spoke to a couple of investors, and, they acknowledge that Apple is probably in a better place than many other stocks. So I think they like it. But this is unfortunately or fortunately, this is a market which is shoot first, ask questions later, and valuation metrics don't really matter at this point. It will probably start coming back to matter at some point, and balance sheet strength will come back into questions. But that definitely is a silver lining for Apple, given all the issues that we're seeing on the consumer front.
All right, Krish Sankar of Cowen. Outperform rating on Apple, price target 370. Thanks for joining us.
Meantime, let's get a news update with Sue Herrera back at HQ. Hi, Sue.
Hello, Carl. Hello, everyone. Here's what's happening at this hour. The White House has new measures to protect President Trump and his staff during the coronavirus outbreak, including taking the temperature of anyone who enters the complex. In the press room, social distancing is being implemented with signs posted on seats that are to be kept empty. The Supreme Court is suspending some operations due to the coronavirus. It has postponed oral arguments through the end of the month. The Supreme Court has been closed to the public since last week. In France, the automaker that builds Peugeot and Citroën vehicles will be closing its factories in Europe until March 27th. The company cited the spread of the virus, disruptions in its supply chain, and a sudden decline in auto sales. Here at home, Scholastic has set up a free Learn from Home website for kids who are stuck at home without school. Content is divided into 4 categories. Scholastic says each section already has a week's worth of content with 15 additional days on the way. That could be a game changer for parents. That's the news update this hour. John, I'll send it back downtown to you.
Yeah, Sue, we all need all the help we can get.
Yes, exactly.
For more on today's massive market drop, let us bring in economist and former PIMCO managing director Paul McCulley. Paul, you are cheering the Fed's move to cut rates to zero. I'm also wondering, though, is the market, you think, correctly pricing in the domino effects of so much of business, of small business, being effectively shut down for several weeks, and the businesses that might go out of business, the employment challenges that many of the American consumers might face?
I think the Fed categorically did the right thing. They threw a mosaic of everything they had at the immediate moment. So you get zero criticism of the Fed, but the equity market is actually discounting the uncertainty, though they know the direction on the real economy. So I don't think there's any sort of indictment from the equity market of what the Fed did. The equity market is looking at the real world, and the real world is going to require a lot bigger response than just the Fed doing everything they can. It's going to take a fiscal policy response to literally get money in people's pockets. That is the bottom line. The Fed can get money into Wall Street's plumbing system, and they're doing it with alacrity. But the bottom line is we need to get money, hard, cold money, in real Americans' pocket, particularly the most vulnerable amongst us.
Absolutely, Paul, and that's what I'm wondering about the consumer, which has been so important to this economy, certainly to these markets. Where the markets are right now, is that kind of helicopter money being priced in, or is this pessimism or fear about the uncertainty on whether that kind of fiscal response is coming?
It's interesting you mentioned helicopter money, because what the Fed did yesterday wasn't helicopter money. It was conventional monetary ease down to zero, plus a huge amount of QE to try to restore functioning in the marketplace. But it was not helicopter money. A helicopter money would be essentially granting Treasury overdraft privileges on its account at the Fed. Was effectively a Treasury could use printed money and get it to the people. So we're one step away, I think, from helicopter money. The Fed can't do that itself. It would require an act of Congress. And in fact, as a citizen and as an economist, I would be in favor of that. But I really want to stress that there's a huge difference between QE, which is dealing with liquidity and market functioning, and helicopter money, which is essentially the fiscal authority telling the Fed that send out checks and we'll run an overdraft on our Fed account.
Yeah, I mean, key point right there. I just want to dig into this a little bit further, though, because the tools that we've seen the Fed basically unleash in this unprecedented manner in terms of timing so much over such a short period of time really in some ways harkens back to 2008. These are the tools that were used for a bank solvency crisis. Are they actually, do we know that they're going to be effective tools for what is a pandemic and what is right now a liquidity panic?
The Fed can do a lot of things on liquidity. In fact, the next one they need to do is to do a commercial paper funding facility like they did a dozen years ago, which I was involved with, which actually restored functioning in that market. And that is a connectivity to the real economy, because you have companies that have to continually roll over their commercial paper, and their natural buyer, particularly money market funds, are not buying longer dated commercial paper. So we need a buyer of last resort for commercial paper, and I think that will happen probably within the next 24 hours, hopefully. So the Fed can do that from the standpoint of keeping companies that issue commercial paper from facing a liquidity crisis. But fundamentally, it is now all over to the fiscal authority and Congress essentially taking the lead in getting money into people's pockets, and if necessary, and I think it is, changing the law so as that the fiscal authority can direct the monetary authority essentially to grant the fiscal authority a overdraft privilege.
Yeah, Paul, that's what I want to ask you about in terms of the political realities of that actually happening. What kind of odds do you give it? And to what degree do we need to hear Powell, even academically, bless sort of the Rosengren school of thought that we heard last week or the week before?
I think Mr. Powell is doing a fantastic job, so I'll be the last person to criticize him. What he did yesterday and what he's done in recent weeks has been superb, and I certainly think that he is encouraging the fiscal authority to step up to the plate big time, and I think he will be cooperative to the max. But I think also appropriately, he doesn't want to take the political lead in telling Congress what to do. He's just basically saying, you have scope to do what needs to be done, and damn it, get it done.
Paul, how important is government communication right now? And I'm talking not just about the economy in general and what they're going to do about that, but also public health and protocol, because we've heard a number of different messages from the White House, from Washington over the past few weeks about this being like the flu, not being like the flu, social distancing, not social distancing. Perhaps they're getting more consistent, but hey, it's only Monday. How important is it for the government, both federal and state, to get consistent in messaging?
I think it's absolutely critical. We're dealing with radical uncertainty on the part of our citizenry because we've never dealt with something like this before. And when you have radical uncertainty, you freeze. And it is incumbent upon our government to provide information that is robust and correct, and also where they don't know to say they don't know. And here, in contrast to Chair Powell, I would say Mr. Trump has been a lost ball in deep rough when it comes to communication in recent weeks.
Paul, I realize that this might still be early days to even be asking this question, but how long would you expect rates to stay at zero? And I ask that because if the expectation is that this is a pandemic, a crisis that's going to last for weeks or potentially months, what will it take when it actually passes for the Fed to start basically restocking its arsenal?
I think we're down here for a very long period of time. I don't think the notion of take back once we get on the other side of the V is got any legs to it. Remember, going into this whole crisis, the Fed had missed its inflation target on the low side for essentially a decade. The Fed wants this economy to come back really strongly and also for inflation to go up. So the whole notion of then they'll come down here to zero and then, in a month or two, take it back, I ain't a buyer of that whatsoever. We're down here for a very extended period of time. Remember, the last time we went to zero, we stayed down there for 7 years. I'm not forecasting 7 years, but any notion of a quick take back is something I think would be wrong. And also, I think the Fed recognizes it would be wrong and would push back on any expectations of that concept developing in the market consensus.
All right, we will hunker down, as many have been saying in recent days. Paul, thank you. Paul McCulley, former chief economist at PIMCO.
Got the S&P down 6.4%. Session low was down almost double that. Apple closing all of its stores outside Greater China as the coronavirus spreads. Our Josh Lipton's in San Francisco with all the latest. Hey, Josh.
So, Carl, Apple really surprising investors with that decision, deciding to close all its stores outside of Greater China until March 27th. Remember, Apple has spent a lot of time, money, and effort to build out this network of stores. Sometimes we just kind of forget how big that footprint really is. In total, Apple now operates a whopping 510 stores around the world, 271 here in the United States alone. 52 stores in that Greater China region that will remain open. That's an operating segment, remember, that includes China, Hong Kong, and Taiwan. Apple's online stores do remain open. In a letter posted on the company's website, CEO Tim Cook writing that the most effective way to minimize risk of the virus's transmission is to reduce density and maximize social distance. I caught up with Gene Munster over at Loop Ventures over the weekend to get his take just on the financial impact of this decision. By his math, Munster's estimating that Apple's hundreds of retail stores account for 8% of total company revenue in a given quarter, and that if the stores do remain closed only until March 27th, as expected, then this decision impacts, he says, revenue in the current quarter by about 2%. But I also did catch up with tech analyst Ben Beharin. Ben is a longtime Apple watcher, just like Munster. He says there's a much bigger concern for investors right now, which is as consumers get more worried about the virus, about the economy, do they now pull back on discretionary spending? How much, in other words, do they hold off on buying those new iPhones, watches, and AirPods? Guys, back to you.
All right, Josh Lipton, thank you. I know in my household, for one, with a couple of kids staying home from school, I'm thinking, do they have the right iPads? Do they have the right laptops to get work done? There might be, at the same time, some other decisions like that being made. Great report. Thank you, Josh. Let's stay on the topic and in Northern California now talk about the challenge of leading through a pandemic for tech CEOs who have perhaps been in that seat for less than a decade. Kara Swisher joins us now. Kara, good morning.
Hi, how you doing?
I am doing fine, thanks. I hope you are as well. So it strikes me, Kara, that even though there's all of this technology for exchanging information over a distance that comes out of Silicon Valley and modern tech companies, the place itself has a lot to do with interacting face-to-face, whether it's these open plan offices, the roads are clogged because people are trying to get to maybe the spaceship headquarters that Apple has in Cupertino or Google's campus where normally the cafeterias are open. How big a shock is this to the culture and operation of tech in Silicon Valley?
Well, for digital people, they're very analog. And as you know from being there, they go into the office a lot. Their offices are mini campuses. It's where people live and work. They do their dry cleaning. So it's a big change not to gather. Because I think that's one of the things that, even though tech, they use a lot of these devices, they are a very gathering kind of culture. To me, I think they've done a pretty good job being very early to announce closings of companies, being very early to announce focusing on their employees, which these companies have always been, and doing a range of things that they are supposed to be doing, like Facebook cleaning up issues around misinformation, which they've been doing, which, of course, is the lowest bar. They should be doing that as a matter of course. Or giving money. You know, Mark Zuckerberg pledged a bunch of money donations, so did Google. And so there's all kinds of things they're doing, including just getting out good information to people and creating an ability for people not to feel adrift. And so for themselves, it's for themselves as well as others.
Yeah. Well, as we're having this conversation about technology, where I think we're having some technical difficulties with the connection right now. So, Kara Swisher, we're going to come back to you in just a moment. In the meantime, let's head out to Chicago to Rick Santelli at CME Group's global headquarters in Chicago. Hey, Rick.
Yes, global headquarters. We don't hear all the other voices, but you know what? Trading floors are wonderful, but the fact that we're up and running at all and markets are fluid is a good thing. Let's start out with the main issue I've been paying attention to. What's going on with that relative value trade? All the yields around the globe, of course, when our Fed basically goes 0 to 25, rates have come down. It wasn't shocking to see them come down yesterday on the announcement. The difference between our 10 and the German 10, 131 basis points, as you see on this chart. That's the closest they've been, basically, in 5 years, going back to January of 2015. And I think that is very significant for a number of reasons, because ultimately, when there is some sort of normalization in the world, we need firmer rates. Europe needs healthier banks. The fact they're getting closer together isn't necessarily a bad thing. Now, 10s minus 2s, it's been all over the place. Now, right now, in the upper 40s, it's hovering around 47. It's virtually the steepest it's been since May of 2018. About 2 hours ago, it was under 40. The long end has been very volatile. Finally, in my opinion, the dollar index is a good tell. It's a good market to pay attention to. Many people are scratching their heads over gold and Bitcoin and all the safe harbor trades. What's a safe harbor at this point? And how long does that safety last? We've discussed it. If you were in the market at 31 basis points on a 10, 69 basis points on a 30 at their all-time historic intraday lows a week ago, you're not feeling that that was a very accommodating position, although it's been more against you than it is now. But the dollar index, on the other hand, don't think of it as a safe harbor. What it is it is in big-time demand. Many countries and economies around the world, the ones that find them just under 95, that's the low close, but it's bounced. So currently, with the dollar index hovering above 98, currently close to 98 and a quarter, what I want to put a question above and right there, it is home base. If we start look for a range between 95 plus and 99 plus in the dollar index. Carl, back to you.
I will take it, Rick, between 95 and 99. Thank you. We will watch that. I'm going to try again with Kara Swisher. The impact of questions about exactly how much Google had planned to do that before the president said it was going to happen. But Google had been criticized for not helping out as much with military things as the president would like. Is this an opportunity for a different stage of cooperation between tech and government?
Yeah, I think so. I think government, you know, you have to separate Trump from governments of the government to try to get information out, to try to minimize misinformation, to get rid of price gougers and things like that, and to provide products. So in that case, in this way, they're working very hard. They met at the White House last week, as you know, tech leaders. And there's all kinds of things they can do. I think that one of the things that's critically important to remember here is that, when these companies do rise to the occasion, they can do a lot of great things. And they can, again, at the very base, provide great information for people who are stuck at home or provide great technology. So I do think you'll see a lot more cooperation between these companies. Between these companies and the government. It doesn't mean some of these issues with these companies is going away. There were still hearings last week about antitrust. There's still issues around all kinds of issues around big tech. But I think for right now, it will go on hiatus until this crisis is over.
Mentality-wise, Kara, how do you think, and maybe it's too soon to tell, we're still very early days, but how do you expect a crisis, a shock like this to affect the Valley? I mean, we both lived through the dot-com bust, which I would argue had a much bigger impact than the financial crisis did on the West Coast. How heavily is this going to weigh based on what happens to valuations, delayed or scuttled IPOs, attitude toward risk?
Well, you're going to see the IPO scuttled. I mean, there was going to be Airbnb and others, and I think Airbnb is taking a big hit here with travel and things like that, and so it's probably unlikely, or so there's some delay in their IPO. Other companies like Apple, of course, which have a lot of retail operations, they're exposed in that way. It's not a huge amount, but it's an amount, including discretionary income spending on things, so they're going to be affected. Other companies like Zoom and others that create these products could be working at home, the idea, and products that help you work at home. People might like this kind of format or get used to it as this thing winds down in months to come, hopefully. So it depends on
when you take rate to the zero bound, I know we talk about this a lot, aspect, and you actually do more damage than good because how it hurts insurance companies and pension funds and individuals. Asset purchases get at liquidity, get at the currency. It's much more efficient. So I don't think that is in their toolkit, and I don't think we'll see it anytime soon.
The op-ed today in the Journal by Kevin Warsh, let the Fed administer an antiviral shot. An emergency lending program would keep a liquidity crisis from turning into a solvency crisis. Your reaction to his comment?
I think that's right. I mean, you've got supply chain breakage, you've got cash drains around the system. The idea of that gets to that point about targeted initiatives that get at lending, get at cash drains across the system. That's a sort of innovation they've got to do, and I think that's really powerful. By the way, I'm going to make one comment about what you were saying earlier. We're seeing valuations in some companies that are cash rich or free cash flow generative. They're going to have a tough month or two. When you put in place some of those initiatives like a lending program, those companies, you got to put them away. You got to do it in small size given the uncertainty of the markets. And you got to think about, gosh, I'm not going to hedge them because you look at the price action in gold, you look at where treasuries are today. I just want to own those companies organically, particularly if the Fed's willing to do some things like described.
You think, obviously you're the CIO and head of global fixed income, but you think some stocks are too attractive to pass up even today?
I do. I mean, I think you got to be deliberate in how you do it. I think using some of the volatility markets, depending on where you can, is also interesting. But gosh, we're looking at companies that are good growers in technology, healthcare, building, construction, that are the multiple you're paying to cash flow, and you've got to haircut it for the next couple of months aggressively. But even when you do that, we've put down numbers where you shock some of these companies down so aggressively, get to significant negative free cash flow over 2-3 months. You're still trading at multiples that are incredibly attractive if you assume some sustainable growth rate over the next 5 to 10 years. So anyway, you're supposed to do that. And again, you're supposed to own them organically and not worry about how do I hedge them within my portfolio. Just I'm owning them because I'm long cash in my position and they're good assets to own.
Rick, we'll leave it there. Appreciate you coming to the phone today for us, too, helping us understand all of this. That's Rick Reeder, again, from BlackRock. Josh Brown, haven't heard from you for a while, and you've heard from a number of real smart investors running an awful lot of money. What are your thoughts on what you've just heard today?
Well, so I talk to financial advisors all over the country, advisors probably combined managing over $100 billion. And one of the things that strikes me as being very encouraging is that for every call advisors are taking from clients about, is this the time to get out before it gets worse? They're getting another call, people that said, you know what, I actually want more stocks. Let's take down the bond position. People that have treasuries have seen gains in those positions. And they're saying, I get it's not the bottom, but I just feel like if I don't do anything here, if the market sells off 25% and I don't react, I'm going to regret it. So you could look at that two ways. You could say, oh, these people haven't had enough pain yet. They're complacent. Or you could say, you know what? These people have learned the lesson of the last 20 years, which is that terrible things happen from time to time, but things get better. I want to point out some research from my colleague, Michael Batnick, about what happens after the stock market declines 25% from its high. That has actually only happened, Scott, 7 times since 1950. Here's the bad news. Over the next 1 year period, basically you could flip a coin. The outcomes are all over the map. But something very interesting happens on an average annual basis after that first year, which is 9.5% gains. And that goes out for 1 year, 3 years, 10 years, 20 years, 9.6% average annual returns if you bought the first day the market dropped 25%. So this isn't a bottom call. This is just a realization that the people who have stepped in and said, you know what, I get that it could get worse. I don't care. I'm an investor for the long term. Those people historically, 7 times since 1950, have been rewarded. So that's the way financial advisors are thinking. And fortunately, many of their high net worth clients are thinking the same way. And that's very, very optimistic and positive.
Weiss, I mean, that's how Lasry, Sandler, and Reeder are. Oh, well, we lost Weiss. But, Joe, that's how those guys are thinking. Lasry, Ricky Sandler, and Rick Reeder. You just heard it straight from them.
Yeah, they're assuming risk, and they're understanding what that assumption of risk is Josh is actually pointing out. It may feel very painful for the assets that they've purchased recently, and they're not going to know where the bottom, but ultimately they feel as though they're going to be rewarded. Scott, again, this is a process. There's much more work that needs to be done. We haven't even begun to tackle the oil issue. Oil's below $30. We need to address that. The Russians, Saudi Arabia, and even the Americans need to collectively get together and see if there's something that they could do in terms of taking supply off the market. That's a problem. So the fiscal response is needed. The healthcare crisis is needed. And individually as a country, the concept of social distancing, how seriously are we taking that as citizens? That's important. It's a mosaic of things that need to occur. It's a process over time. I'm optimistic they're going to happen, consistent with what Mark Lazary, Ricky Sandler, and Josh are saying.
We'll add our fourth special guest of the hour today. Dick Costolo is the former CEO at Twitter. He is currently managing partner at 01 Advisors. He joins us on the phone. Dick, welcome to the program again. It's good to talk to you today.
Yeah, great to talk to you too, Scott.
Give us how you're thinking about the markets. You can speak through a tech prism or just as a broad investor and a big thinker. What do you think about where we are?
Well, I sort of agree with what your most recent folks on the show have talked about. It's historically, this is a great time to make sure you're thinking for the long term. I've been buying, just slowly buying on a day-to-day basis, not worrying too much about whether we're going down further or whether we're going up big. We'll get through this. The world will get through it. It's going to be rough sledding here for a while. But trying to predict when, as everyone has said, trying to predict the bottom or trying to wait for things to fall out of the bottom is just a silly way to go about it. So at the end of the year, the people who have put money to work now will be happy about it. That's the way I think about it.
Can you give us an idea of how the tech community is thinking about all of this and what broad impacts there may be out in the Valley?
Yeah, it's a great question. I think there are sort of two sides of it. On one side, there are sort of a growing chorus of folks who feel like, look, the social contract between, the country and our business leaders is the country gives us space to innovate the way we want to innovate, to pursue our dreams, to make and keep a fortune in many cases. And on the other side, we're expected to create opportunity, create jobs, and be real leaders, and step up to the microphone in good times and in bad. And I'm sort of surprised. There's I think a growing segment of folks out here who feel this way. Sort of surprised we haven't heard from more of the business leaders and executives. For example, it would be helpful to hear from the Costco folks, the Amazon folks, the Walmart folks about the supply chain. And there's been a comment here or there, but not a lot. And I think a lot of people in the country would like to be reassured about supply chains and that products and goods are going to be there when we need them in the next few weeks. And then similarly on the tech front, it'd be helpful to hear more from the Googles of the world about what they're doing beyond just the things that have been announced in random presidential press conferences that prove to be partially true. And where we're headed, and what they're gonna try to do about it. So, I agree with those folks. I'd like to hear more from our leaders on all those points.
What responsibility do you think our social media creators and or CEOs, because the founders by and large are the CEOs of those companies, have at a time like this with spreading a needed message of any kind? The government is trying to tell people you need to socially distance. And you need to do it now. To what degree does Dorsey need to get out on Twitter and Zuckerberg on Facebook and Spiegel on Snap? To what degree they even can and help in spreading that message? Because I haven't seen it, and I admittedly might have missed it, but I don't think I did.
Yeah, I think it goes back, again, generally to my point. I think all of these tech leaders, it'd be helpful if they stepped up and were talking to the country more about the things on their platforms that are true, misinformation that they're helping eradicate. The Zoom CEO did a great job of stepping up, and Eric, and providing his platform for free for some period of time to U.S. education, the U.S. education system right now. It'd be helpful to hear from more leaders across the board on all this stuff. So, in short, agreeing with what you just said.
Yeah. Dick, I know you're busy, and I know you had a lot going on today, but made some time for us. We appreciate it. I'll talk to you soon.
Happy to do it, Scott. So long.
Right. That's Dick Costolo for us. Josh, do you want to react to that as well? I mean, you're as big of a player in the social media landscape as we certainly have on our program and maybe in this building, you and Kramer.
Yeah, well, so I appreciate that. I think that YouTube in particular has been doing a lot of the right things in terms of deliberately removing things that are misleading or conspiratorial. And I do think that in general, social media is what separates this from prior crises. And the example I want to give you is, can you imagine an episode like this prior to us being able to work from home and communicate with each other on Facebook, on LinkedIn, to verify that our friends are okay? It would have required 100 phone calls a day to be in touch with as many people as the average American is now in touch with. Now, here's the negative side of that. Social media is beaming images to us of overrun hospitals in Italy. And that's probably something that we would not have had to psychologically deal with in prior crises. So I think we're very adaptable in modern society. I think as much of the negative side of Twitter and Facebook, and I could go down the list of all the things we don't like about what those services do during a time of crisis. I do think, though, that the ability for us all to be talking to each other in real time at all times, ultimately, if you had to pick and choose, we have it or we don't, I think everyone would say, no, let's keep it. And so that's the role that those firms are playing. And so far, so good.
Steve Weiss, back with us.
Yeah, so look, I mean, I agree this is not a financial crisis. My point was that if it were, it would be better. But the toughest thing is sitting on your hands when you see stocks down 50%, not saying, I got to be in. But the story we're telling today is that there's no different story last week or the week before. However, having said that, I did add to Facebook on Thursday night, added again Friday, because I could somewhat analyze that fortress balance sheet. This is not going to hurt their business. It'll help their business. I added to Google last week. I added to Qualcomm. And I also initiated a position in a company, Keysight, which is just a phenomenal story. Joe used to own it. He's out of it now. It was a great sale. I'd urge him to get back in. So there are opportunities. But to me, this environment is about managing risk and your point of entry as much as it is about resisting buying companies just because they're down 30, 40%.
I hear you, but I guess one thing I take pause at, and I've been trying to, put out into the Twitter sphere, what's the signal going to be that maybe we have bottomed in stocks? Is it a peak in U.S. cases so that at least we have some sense that we're heading towards the end of the tunnel? And then when Eamon Javers comes on and says that the most optimistic for a peak is a month, and the least optimistic is 3 months, which feels like an eternity. The prospects of this country being in effect in quarantine or sequestered from population for that long seems unbelievably daunting. Thus, how do you make a decision on when we may bottom when it could be the delta between 1 and 3 months? It's impossible.
Exactly, and that's my point. So I'm not going to be able to find the bottom as I wasn't able to find the top going back, just a few weeks ago. But to me, it's when we start seeing the cases really pick up. When you start seeing, and keep in mind, it's always the worst people that get tested. So you're still seeing deaths rise exponentially in Italy, the geometric progression. So as sequesters and quarantines occur with greater frequency and people don't leave and those test results come back and you see more and more deaths, which nobody wants to see, I don't want to see, I feel terrible for those people, that's when, to me, it'll be the maximum pain issue, and that'll be my buy signal, which may not be the bottom of the market, but at least I know I'll have discounted the hysteria. To me, this has not been hysteria so far. This has been more or less orderly, even, yes, down to 10% moves.
Yeah.
So that's what I'm waiting for.
Joe, Ed Yardeni says this could be a fast bear market like that of '87. However, this time a short recession is likely, but perhaps the worst is over for the forward PE. You want to opine on that point of view?
Well, I think Ed is making some very accurate points. Clearly, the market is pricing in some form of recession. I also think, in speaking to a lot of executives on Wall Street and investors over the last 3 days, Wall Street is also pricing in the fact that they do not want gridlock. They want unity. And I think, unfortunately, right now, the markets are understanding that there does not seem to be the perception of unity. Scott, let me remind you, 2004, the tsunami that killed 165,000 people. Very quickly, President 41 and 42, President Bush and President Clinton came together under the direction of President George W. Bush and led the charge in a humanitarian effort. That type of unity is exactly what we need as a society, but also the markets, in terms of how they're pricing things now, are demanding that unity. This is not a time for gridlock for the markets.
Yeah. Josh, I mean, we need something substantial and soon from D.C., right? I mean, I don't want to have to go to my desk and dig for those rise above buttons that we were all wearing a decade ago, you know, telling these politicians to get over the partisanship and darn it, just think of the best for the country.
Yeah, I do remember that. I think that corporate leadership has been incredible. I think leadership on the part of people who run hospitals has been incredible. Like, I'm holding my breath for Mitch McConnell and Nancy Pelosi and everyone. Like, I expect industry bailouts. I expect some sort of relief for people who are waiters and waitresses or working in jobs where they're just not going to be at work for the next few weeks. I do expect that they will take measures like that. One other thing I wanted to make sure I mentioned, Kroger is an up stock today. That's ticker symbol KR. If you recall, Warren Buffett filed a 13F on Kroger from last quarter. I think had bought up to a $500 million worth. I'm not 100% sure on the amount, but Kroger is open for business. The shelves are being cleared, and they have people stocking the shelves when they get cleared with new items. This is an incredible effort by minimum wage employees in most cases at Kroger, Target, Walmart, Walgreens. We have spent the last 5 to 7 years dismissing brick and mortar stores and, by extension, their employees as though they're the past, who needs them, blah, blah, blah. I think we're done with that. I think maybe these stocks deserve a higher multiple in relation to the Shopifys and the Amazons of the world. We see how important it is to have these physical locations. All of the employees and executives at these companies deserve a round of applause for keeping the stores open in places like where I live, Nassau County, which we're being told we're on social distancing. We can still get groceries.
That's right. No, a debt of gratitude for certain. I'm glad you said it, and I think we all send that same message. I don't have much time left, Steve, before I go, but our friend John Spallanzani, sends an email out, and it says he's looking at the financial stocks, which I know you've invested in at times more heavily than others, obviously, looking at their performance today and their year-to-date performance. And I mean, the declines in some of the financials today is just astounding, asking where is the boogeyman hiding? We're talking about Citi down 17%. And I just picked that name out of a hat, but I could list any of the big banks or the regional banks that are getting absolutely hammered. Are we at a point of worry at all about any of these institutions? And when you see declines like that, what are you thinking? Maybe I lost Steve Weiss. Joe, are you with me?
Oh, no, I'm here.
Oh, Weiss.
I'm thinking Europe, but I'm not thinking we're anything like Europe. The only reason I'm thinking Europe is negative rates. Now, Rick Reeder, who I think is phenomenal, says we're not going to negative rates. I agree. But there are so many other values out there that I'd rather buy if I were buying first, that I've got time to buy the banks because I'm not worried about them going out. If they didn't go out in 2008, which was a financial crisis, and this isn't, I'm just not concerned about it. I'd be more concerned, frankly, about some of the BDCs, the business development companies that put out credit to the secondary and tertiary institutions that may not be able to pay it back. Those are bigger issues. Mm-hmm. But in terms of the banks, we're fine. I just don't think you buy them now. There'll be a time to buy them. Do I think if you buy Goldman right now, which I love, but I'd sold a lot higher, that you'll do fine in 3 years? Yes. I just don't know in the next year. It's going to take a long time to unwind what's looking like a very flat yield curve, which may even become, I don't think it can become inverted without going negative rates, right? Because we're at zero.
Right.
I think it's a very long time.
I got to run. Thank you, guys. It's different, but it was a good conversation nonetheless. We'll see you guys in the days ahead. You guys all take care of yourselves. I want to remind you as well that tomorrow on Halftime, Social Capital's Chamath Palihapitiya is going to be back with us. We'll get his insights, which are always worth listening to. Tonight, our special, I'll see you at 7 o'clock tonight for our special report, Markets in Turmoil. We look forward to that. Let's give you a picture of where we are trading right now on Wall Street. The Dow at its lowest levels was down about 2,800 points. So we've come off of that. We're still down about 2,000 points. The Dow is right now at 21,128. And by the way, the S&P is still holding up above its December 18 level, and that's worth keeping an eye on. Thanks so much for watching. Everybody take care of themselves. The exchange begins now.
Scott, thanks, and welcome, everybody. As we continue CNBC's breaking news coverage of markets in turmoil, I'm Kelly Evans, and as Scott just told you, stocks are sinking again today as action from central banks around the world has failed to reestablish investor confidence. Here's where we stand. Circuit breakers were triggered less than a minute after the open today, and at the lows, the Dow fell nearly 2,800 points. It's down just over 2,000 points right now. Oil tanking as well. At one point, it fell below $29 a barrel. On Capitol Hill, the coronavirus task force is expected to hold a briefing at 3:30 Eastern time. The Senate is returning today to take up the House bill that passed Friday night, but no vote is scheduled yet. And 3 more states, New York, New Jersey, and Connecticut, have imposed restrictions on business and limited all events to fewer than 50 people. And just breaking in the past half hour, Larry Kudlow says the administration would consider sending cash to households as short-term relief. Let's get right to where the action is now with Bob Bassani on the floor of the New York Stock Exchange. Bob.
And Kelly, we did see, of course, another trading halt, the third one in a week, less than 1 minute after the market opened. We are off of the lows, but not by much. We've rallied a little bit and then drifted back down. The low for the S&P 500, take a look at the intraday there, 2409, I believe. So we're well off of the lows. But as you can see here, drifting a little bit lower in the middle of the afternoon. No bounce in most of the major sectors. I noticed airlines doing a little bit better, but still on the downside. Americans still down. We had Larry Kudlow commenting earlier that the airlines were asking for assistance, but no comment about whether assistance would be granted to them. You see, though, those airlines well off the lows. Dow stocks here, I would say generally the Dow movers, industrials and bank stocks, so we're talking JP Morgan, Boeing, faring worse than more defensive names like Coca-Cola and Procter & Gamble. Again, we noted this bifurcation in the market beginning last Thursday. Finally, if you take a look at some comments here from, I see Stacey Cunningham just making some comments on Twitter. This is, of course, the president of the New York Stock Exchange. It is important for the markets to remain open and for them to function in a fair and orderly manner as they have been. And Kelly, I think this is an indication. She goes on to say closing the markets would not change the underlying cause of the market decline, would remove transparency into investor sentiment, reduce investors' access to their money, and would only further compound the current market anxiety. Kelly, I think this is a sign that some people have been calling for the markets to be closed in general, and obviously she doesn't believe that. And we saw Secretary Mnuchin on Friday very much reiterating his opposition to closing the markets as well. Kelly, back to you.
Bob, a related question to that. Now that New York is clamping down on public gatherings and events with more than 50 people, that wouldn't apply to something like the floor of the New York Stock Exchange, would it?
Oh, no. This would be one of those rare exemptions for sure. Although, as we reported on Friday, the New York Stock Exchange does have a contingency plan and has for decades to continue to trade markets, even if the floor had to close for whatever reason, a flood or any kind of situation, including a viral outbreak. They've already told us if that happens, they're going to do another deep cleaning. They did one on Friday and reopen as quickly as possible. We'll see if that's possible. But under any circumstances, the message from on high, right at the very top, is they want to keep the markets open.
Sure,
Kelly?
and the trading floor. But, Bob, it is interesting. I heard the NASDAQ saying, that's the benefit of having a digital trading floor. We don't have to deal with stuff like this. And, I wonder if, again, if you're the New York Stock Exchange, if it's just one more little push towards saying, do we need this physical presence?
Certainly that's an issue. However, the counter to that is they have been operating the floor for, since the 1860s, essentially. Of quite well, and a viral outbreak was not one of the things that stopped trading in the last couple of 100 years. So certainly this is one of those rare black swans. We know that the NYSE has closed several occasions. Never, though, for any kind of viral outbreak. The markets have closed, but not the NYSE.
All right, Bob, thanks very much. Bob Bassani, who is at the New York Stock Exchange. And while stocks have continued to plunge, bond yields started to move higher last week. Now that the Fed has cut rates to zero, the 10-year yield has sunk. It's down to about 78 basis points, 0.78%. Rick Santelli is following all these moves, Rick, because you have to say there's not been as clear a narrative for the direction of bond yields as there has been for stocks lately.
You know, but that makes perfect sense. Listen, the Fed could do all these things, and maybe it is good for the psyche of the marketplace. I'm not going to have that discussion. Other central banks can throw kitchen sinks or not, but at the end of the day, the fact that businesses aren't going to be getting revenues, they're not going to be sending out bills, that's what's going on. You can talk about confidence, but the central banks can't address how many cases, the numerator and denominator, mortality rate, all the things the market needs to get its arms around on the coronavirus to truly do better pricing. Look at a 2-day of 2s, look at a 2-day of 10s. You know, we're getting back into the previous session's ranges from Friday, but Kelly's right. What the central bank did was, in a way, pull the rug out. Yes, it's easing, and it's going to make the gears potentially turn better, but it really does throw a GPS monkey wrench into it. And if you look at what's going on with the yield curve, you know, we had many guests today say, yeah, maybe the yield curve doesn't matter. It does matter. The complexion of the curve gives you a very good idea if there are short-term funding glitches. And finally, the dollar index. Maybe it's not going to have its 5th up day in a row, but in this instance, that might be a good thing. Let's make sure all the rest of the world that's having a really rotten couple of trading sessions is able to get their hands on as many dollars as they need to. Think emerging markets here. Kelly, back to you.
You know, Rick, I don't want to catch you flat-footed because I know you're not on the floor of the CME right now, but I want to ask you about inflation expectations. You know, if you wanted a benchmark for if the Fed's moves are quote-unquote working, you'd think they'd be increasing inflation expectations as a sign that the economy is going to start to get back to normal and back on track. And the opposite has been happening today, hasn't it?
Well, I'll tell you what, in my opinion, I think you're going to see more deflationary pressures right now. But there is little doubt when the markets, when doctors, when we all get our arms better around the coronavirus dates, mortality rates, you know, different hot zones, once that occurs, my guess is that you're going to see demand shoot up, and that demand is going to be the type of demand where, hey, I don't care if I have to pay overnight. I don't care how you get it here. I want it here tomorrow.
Right.
I think we do get a spike on the back end of this on the inflation side.
It makes it doubly dangerous. Mike Darda was making that exact same point today. All right, Rick, thanks for now. We appreciate it. Sir Rick Santelli out in Chicago. The market is responding. Well, let's ask, is the market responding so poorly today because the Fed didn't do enough with its emergency moves yesterday, or because it's not the right kind of help? Joining me now to discuss that, Bryce Doty is Senior Portfolio Manager at CIT Investment Associates. Neil Hennessy is Chief Investment Officer and Portfolio Manager at Hennessy Funds. And Daniel Ahn is Chief U.S. Economist at BNP Paribas. So it's great to have you guys all here. Daniel, you're the economist. Let me begin with you. Do you think that the Fed's moves will have an impact, at least on the economy in the longer run?
It certainly will have an impact on the economy. I think Chair Powell said it perfectly when he said, look, monetary policy, it can't cure a virus, it can't fix a broken supply chain, but it can provide support to business and household sentiment, and it can continue to keep financial conditions accommodative. So, yes, I don't think it's a sufficient condition to support the economy out of this likely pending recession, but it is a necessary condition and will probably make it not as bad as it might have been.
Okay, and Bryce, you know, people have made the point that that might be true, you know, say in the next couple of months, a month from now, 2 months from now, 6 months from now, but for right now, businesses face a cash crunch. So on that count, is the Fed doing enough to help here, or is it really the government that needs to step up with more?
Yeah, I think it's really.
Well, I think the Fed did need to.
Bryce Doty, go ahead.
Sorry. Okay, thanks. I think the Fed was right to hit the panic button and flood the markets with cash, because there is a massive need for cash on all levels, both individuals taking money out, running the bank types of cash, but a bigger problem in bonds is liquidity. There's very few bonds even trading right now. Even money market type bonds are trading poorly, if at all. So they need to address that liquidity in the biggest way possible, which they're trying to do. But again, you're correct. It doesn't really solve the underlying problem of the virus, and people can't. Well, if we have school break for 3 months in the summer. Let's take one of those months and do it right now. Close all the businesses right now. Rip the Band-Aid off. Take the pain, the economic pain right now to save bankruptcies and job losses and deaths down the road. And if we did that, the stock market could at least try to quantify what the hit to earnings is going to be. Right now, it's so vague. You don't know if this thing is going to stretch on for 6 months or 2 months. And so that's why we see this intense volatility.
Sure.
Until we get serious about dramatically slowing the spread of the virus, you won't find a bottom in stocks.
Neil, the problem with doing that, with saying, okay, we're going to take all of the economic pain right now, is that it will put some companies out of business. I mean, it will push workers to the brink. So you want that reassurance that there's going to be some kind of backstop. I don't know the best way of channeling that, especially to the point Bryce was making about there being no clarity on earnings and so forth. What are your thoughts both on the right medicine for the economy here and how to invest?
Well, I think, first of all, we have to remove emotion. Kelly, I've always said if emotion enters a conversation, at some point in time, it's going to get ugly, and I've been there more than most people. And the same with the financial decisions. You look at what the Feds did yesterday. I mean, it's sort of like, why involve emotion? We are going to have casualties, especially in the small business arena, where they don't have the cash flow, the bars, the restaurants, small businesses. We have to somehow try and figure out what we can do there, but there are going to be casualties. But as you notice all day long, all these companies that are shutting down are saying, well, we're going to pay our workers. We're going to keep trying to keep them on the books. This is a situation where apparently we haven't hit before with this new virus. But the bottom line is, underlying the economy, the fundamentals were very strong. Look at the S&P 500 company. They're sitting on over $5 trillion in cash. There's $3 trillion in cash in money market funds and building on a daily basis. Back in 2008, there were underlying financials that were deteriorating. This isn't so today, Kelly. In fact, the market goes down 2,000 points, and it's not even a headline.
So, Neil,
I mean, it's
you're right.
crazy.
Once we go down 30% peak to trough, there's plenty of headlines. So let me ask you this. Are you comfortable keeping your clients' money fully invested in the market? Are you taking any additional moves because of some of the sell-offs that you might not have done before, or are you going to wait and see how this all plays out?
No, I think being fully invested, you're fine. When you look at a 30-year Treasury at 1.4, or you look at the Dow Jones yielding 3%, it doesn't take a genius to figure out what's going to be better in 30 years. But essentially, these companies have been cut in half. The banking sector, Kelly, is as strong as I've ever seen it, and they're getting crushed. So at some point in time, it's going to turn. Remember, in the last 38 years, there's only been 6 down markets. And on average, those down markets were down 10%. 32 of those markets were on the upside. And on average, Kelly, the upside was 18%.
Okay.
So just don't panic and sit and buy quality, and you'll be fine.
So, Daniel, let me bring you back into this on the economics of it. I saw a number, and I'm curious what your own numbers are from Goldman over the weekend. They think the economy is going to shrink at about a 5% pace in the second quarter of the year, which hasn't even started yet. So we're talking about April, May, June, and then a rebound. You guys, as far as you can tell, what's the economic hit going to look like?
Yeah, no, that's a great question, and we're all trying to peer through the fog of war here and trying to understand how much the economic hit is. I think Q2 is looking out to be a pretty severe contraction. I don't think we see a rebound quite as strong as what Goldman sees in Q3, but it does bring up the broader point that all that markets are reacting right now is just a fear of the unknown. I think now we're starting to get handle around what are the known unknowns on all of this. But there's still a lot of uncertainty. It's not going to be for a few weeks yet before we even start to see in the harder data what the actual economic impact is. And the real big question of all, how resilient is the economy going to be from all of this? We were going into this crisis on a fairly strong footing. Is this virus ultimately going to be a 3-month sort of duration shock that the economy can absorb, or is this going to spill over into longer that may cause deeper pain?
All right, we have to go
in the second half of the year.
Bryce, I'll give you the final word on this. Then we've got the Federal Reserve trying to do stuff, the fiscal government trying to do stuff. I mean, we're just waiting on the numbers, right, to see are the kind of self-quarantine measures working, and is that the thing that you think could do the most for this market?
Well, we are trading off the emotion more than that data. I mean, emotion for a portfolio manager is the gift that just keeps on giving. And we had a lot of long treasuries anticipating concerns, and we're just starting to stick our toe back into risk markets right now, and we'll probably continue to do so over the next 4 to 6 weeks as we see announcements like what you just alluded to that would finally get us to a better place to where you can more accurately project what's going to happen. But in the meantime, try and lean against whatever emotion is going out there, and over time, 6 months later, you'll look back at some of those trades, and they're going to look pretty good.
All right, gentlemen, thank you all today. Bryce Doty, Neil Hennessy, Daniel Ahn, talking about the economy and these markets. Don't forget to catch much more of CNBC's special coverage of the markets in turmoil in our report tonight at 7 p.m. Eastern Time. We have some breaking news on the airlines now. Let's get to Phil LeBeau for that. Phil?
Kelly, we've been talking for some time about the airline industry looking for relief from the federal government to assist them as they look at this huge decline in terms of business, people not boarding flights, taking flights, etc. Because they're losing billions of dollars, they are looking to the White House to provide this type of relief. We have a document that outlines what Airlines for America is looking for. $25 billion in grants. That's immediate relief for the passenger airlines. $4 billion for the cargo carriers. Medium term, they would like greater liquidity issues to help them as this stretches out over the next several months. Those would include unsecured loans and loan guarantees. And then finally, longer term, some tax relief. And that would come in the form of release from federal excise taxes to the Airport and Airway Trust Fund. So you're looking at the airlines now at least putting forward a price tag in terms of what they believe is needed to stabilize the industry, which is losing billions of dollars. $25 billion for the passenger airlines in terms of near-term grants, $4 billion for the cargo carriers near term, and then you've got loans and loan guarantees as well as tax relief. Kelly?
So, Phil, as you were talking there, American Airlines almost went green. I mean, this is an airline stock that's down 60%. United, interestingly enough, still down double digits in the session today. I don't know if you know the kind of whys of the different reaction there, or if you can talk more about whether this request, investors are considering it carte blanche, granted, or if they expect it to have to go through a lot of changes first.
Oh, I think they know that it's going to have to go through some changes, but I think most investors are looking at the airlines and saying the federal government does not want to risk one of these guys going under. And that is a distinct possibility if this stretches out over, let's say, a month, 2 months. If this gets dragged out where there is no form of a final decision in terms of what type of aid the airlines will receive, you're going to see real financial pain for these carriers, let's say a month or 2 months down the road. They are hemorrhaging cash, Kelly. They need something to be decided quickly. Now, is $25 billion too much? It may be, and the White House might push back and say, look, we're here to help. We're not here to give you $25 billion in terms of a near-term grant, but let's talk about what is possible. So I think any relief rally, if you want to call that, with the airline stocks is because people believe that ultimately the White House will step in to assist the airlines.
And American Airlines, the worst hit of all of them, fractionally positive on that news. Phil, thanks very much. Phil LeBeau in Chicago for us. Now, as schools and businesses start closing because of coronavirus, my next guest says the crisis will get even worse before it starts to get better. Joining me on the CNBC Newsline is Ian Bremmer. He's president of the Eurasian Group. Ian, I actually think that's probably something everybody thinks at this point. I mean, it's basically all-out panic, wouldn't you say?
Well, I mean, there are a lot of people that are panicking. I think the importance here is just to understand who has resilience and what the geopolitical backdrop is. That's what we focus on. I think the problem is that unlike 2008 financial crisis, And unlike, say, 9/11, where the domestic and the global response was pretty cohesive and pretty robust, that's not the case here. So, I mean, in relatively short order, we will get a handle on the epidemiology of this crisis, and I think markets will then, at whatever new level, start to become much more stable. But the political response is really dysfunctional, and that does mean a lot less efficiency and a lot more economic pain for citizens that have to live through it. That I think is where this looks more unprecedented.
So in that sense, we just heard from the airline saying they $25 billion they're asking for help, saying otherwise they could run out of money by the end of the year. How would you like this to be structured in terms of getting relief to the industries that are most affected, ultimately to, hundreds of thousands of small businesses across this country that need that help, and to the workers as well?
That's right. I mean, we've seen very robust responses now from the Fed, and I certainly think that makes a full-on financial crisis less likely, but we now need to see a really big fiscal response, and you're going to have that coming out of the U.S. government in relatively short order and an initial way. But if you ask me, what May looks like, the headline numbers are going to have to be very large. I mean, perhaps $1 trillion or more. By the way, I fully expect that. I think that there is recognition, even though it's election year and even though nobody particularly wants to give a win to the other side, what we saw from Pelosi and from Secretary Mnuchin on Friday and Saturday, I think we're going to see again in much larger form as we get through May because, frankly, there's an awful lot of people, the great inequality. Yes, the economy was humming along pretty well, but a lot of Americans weren't feeling it. And that is obviously going to be exacerbated dramatically over the course of the coming months. Frankly, that worries me long-term a lot more than the healthcare system getting overloaded does. I think we can handle the latter. We're going to have a harder time with the former.
So let's talk about dollar figures here in terms of government spending, and also to look at the other side of this. So how much do you think needs to be put in the economy now, and what do you do to then ameliorate the either deficit, the debt that results from that, or do you skip that step entirely and have the Fed basically monetize that issuance? I mean, how would this look? And again, going back to that first aspect of this, how big are you talking about?
Well, again, what we're looking at right now in terms of what's heading towards passage in the Senate is probably going to approach $500 billion alone. They still don't have an official score on that. I think the eventual U.S. fiscal response is going to be well in excess of $1 trillion. And, yeah, that's massive if we talk about the impact on the long-term deficit of the United States. But you do have to actually take care of Americans in a time of crisis, and you will worry about the longer-term implications for the structural health of the U.S. economy later. We've been more than willing to do that, running trillion-dollar deficits over the last few years. I have no doubt that we will do it now when it truly is urgent.
Do you have to have it be deficit funded, though, or could you have U.S. households effectively fund it through Treasury issuance? Could you have the Fed fund it? Because this kind of brings them full circle to the amount of balance sheet expansion that they're looking to do anyway.
Yeah, look, I mean, that's a question for the economists, not for political scientists. But as a political scientist, I'll tell you that the important point where we're going to be arguing over the next 3-6 months is simply, are we getting this stimulus in the hands of the average Americans and small businesses, and frankly, some large business sectors, too. There is no question, despite how well the economy was doing, that they are going to need this dramatically. The level of, I mean, you can put, Fed rates wherever you want,
right?
But the reality is that is not going to stimulate spending in this environment. We are, literally this week, we are shutting down a large part of the U.S. economy. And getting that restarted, getting people to trust in traveling again, in going to work again, in consuming again, is going to take a lot of work. And let's keep in mind as well, there's a lot of mistrust around basic information right now.
Sure.
And frankly, that makes it a lot worse. That was something that this administration has not helped in the early stages of this crisis. I think they're now doing a better job, and certainly we've seen from Pence and we've seen from Fauci being out in front over the course of the last week, that there is more consistent information coming from the government, the administration, but the social media, the fake news, the mistrust, and the polemics coming from both sides here is going to make it a lot harder economically for the average American to rebound.
Yeah, no, I can tell you even last night, I was affected by one of those text chains that said, hey, there's going to be a quarantine. There's going to, it's happening now. It's not happening. We need to get out in front of this misinformation, so to speak. Ian, thanks.
My pleasure.
All right, Ian Bremmer is with the Eurasia Group. Let's talk about some of the grocery stores affected by this concern. They're open, but if you hope to find hand sanitizer, disinfecting wipes, shelf-stable food, you might be out of luck right now. Frank Holland is outside of a grocery store in New York with more on this for us. Frank.
Hey, good afternoon, Kelly. It can take up to 5 days for a grocery store just like this one on New York's east side to restock to meet the coronavirus-fueled demand. This is produce that actually just arrived a short time ago, and the supplier's trying to get it in the door. Earlier today, we looked at the shelves where you might find sanitizer and paper products and staples like meat and pasta. They were completely empty. And we also saw suppliers trying to get goods in the door as well. So generally, even with this high demand, it can take goods like sanitizer and toilet paper a day or so to get into stores like this. When it comes to things like bottled water and produce, that's more to like 1 to 2 days. It also depends on where that fruit and produce is sourced from and where it's being delivered to. We spoke to the owner of this supermarket. He said demand has increased by more than 100% in recent weeks.
Primarily disinfectants, hand sanitizers, cleaning products, paper products, toilet paper, tissue paper, paper towels. We are getting restricted on these items. Limited supply is coming in, and we're asking customers that when they do shop, just please take enough just for the next week or two so everybody can get some.
And shelf-stable foods like oat milk, for example, those sales have really grown in recent weeks. They're actually up more than 300% year to date so far. Sales of beans, those are up nearly 40% year to date so far. And the coronavirus impact could actually reach other aisles in grocery stores. About a third of household goods, those are sourced in China, and almost that much of pharmaceuticals and medical goods. Back over to you.
All right, Frank, thanks very much, Frank Holland. And we will speak with a grocery executive, in fact, in the next hour right here on CNBC. But first, let's get a check on the markets right now. We're approaching half past. The Dow's down 1,940 points. Stocks are lower across the board, but at the session lows, the Dow was down nearly 2,800 points today. Still, the Dow, the S&P, having their worst month since October of 1987. And at one point today, the Dow was down 30% from its recent record high only a little bit over a month ago. Again, right now, we're down about 8.3%. 28 out of 30 Dow stocks are lower, led by Boeing and Travelers, with Boeing now down 58% in a month. In terms of those two in the green, they are Caterpillar and Walgreens today. Over in the S&P, all 11 sectors are lower, led by financials and real estate, which are both down precipitously here. I should say more than 10%. And let's take a look at oil, which is down 8% right now and earlier broke $30 a barrel. That's a 55% drop from its high last April. And finally, take a look at the cruise lines, which are actually in the green today. Royal Caribbean and Norwegian both higher after massive losses year to date. Now let's flip to shares of Apple, down 8% today. The tech giant taking drastic measures to close all of its retail stores worldwide outside of Greater China, and that for the next 2 weeks. CEO Tim Cook writing in a blog post that the company had learned lessons from this outbreak, saying, quote, one of those lessons is that the most effective way to minimize the risk of this virus's transmission is to reduce density and to maximize social distance. Saying as rates of new infections continue to grow in other places, we're taking additional steps to protect our team members and customers. Apple's online store, the App Store, its remote tech support will all remain open. Coming up, the XRT retail ETF down 10% today, as well as more and more companies close stores to help slow this outbreak. That's putting more pressure on an already stressed sector, and we'll look at who's shutting down right now and who could end up shutting down for good. Plus, Netflix may not be as coronavirus proof as you think. We'll tell you why that stock is down nearly 6% today. And with new virus information coming in constantly, we'll catch you up on where things stand right now in this country. We're back in 2.
profit.
Welcome back. From curfews to closing schools, playgrounds, and placing restrictions on restaurants, states nationwide are taking some drastic measures now to slow the outbreak. Let's get to Sue Herrera, who has the very latest for us. Sue.
Indeed, I do, Kelly. Here's what's happening right now, everybody. The World Health Organization today calling on countries around the world to ramp up testing. The number of confirmed cases nearing 175,000 today, with more than 6,700 deaths. For the first time since the outbreak began, cases outside of China outnumber those inside. Europe, now the epicenter of the pandemic. Here in the U.S., the governors of New Jersey, New York, and Connecticut announcing today that the three states are banding together where they feel the federal government is lacking in response to the virus. All three states will ban gatherings of more than 50 people, and as of 8 p.m. tonight, all gyms, bars, theaters, casinos, and restaurants will close. Bars and restaurants to operate as takeout or delivery only. Now, beyond the tri-state area, the CDC has recommended the cancellation of events with more than 50 people for 8 weeks. New guidelines on curfews and social distancing may come from the White House Coronavirus Task Force a bit later today, with officials warning Americans to stay home. We'll be monitoring all of that for you. For live updates on the coronavirus outbreak, check out CNBC.com. Kelly, a lot of great information there that people need to access.
Yeah,
Back
and
to you.
updating minute by minute. Sue, thank you. Sue Herrera. Well, my next guest said weeks ago that the government needed to step in with direct aid to workers and businesses. Is it too late to prevent a deep hit to the U.S. economy now? Joining me on the NBC Newsline is Larry Lindsay. He is CEO of the Lindsay Group and former director of the National Economic Council. Larry, it's good to have you here. Welcome.
It's great to be on. Wish it could be in person.
Us too. And listen, you know, you were so ahead of this, Larry. If people had listened to you, we might have been able to prevent this from being as deep and as bad as it is right now. So, look, as you pointed out, Hong Kong was giving people $1,000 checks weeks ago. Why is the U.S. dragging its feet here? What can be done quickly at this point to prevent a worse hit to the economy, more people out of work than is necessary?
Well, I think we are going to have people out of work, and there's probably not a lot that can be done about that. When you have social distancing, then you're going to see a big drop in the number of people, say, being hired. You don't even have to have mass layoffs. A little less than 6 million people leave their jobs in any given month, 2/3 by their choice, 1/3 by their employer's choice. And a lot of those slots aren't going to be filled. So we're probably going to have a big drop in employment. My guess is that it's going to be in April. There may be some of that in March. So there is going to be a downturn for sure.
Right. So I think we're talking about, you know, we could get a jobs report that shows a huge decline of jobs. But you're saying it's not so much because people are getting laid off right now. It's because they're not getting hired. How long do you now anticipate this to drag on? Do you think more people will end up getting laid off because there's not enough? Sure, the Fed is acting quickly, but it's not clear that's going to do much. I mean, there's not enough yet from the federal government side, is there?
No, there's not at all. You know, you had Scott Gottlieb on earlier this morning, and my views are with him on this. He said we're probably going to see peak in cases at the end of April, and so we'll be coming down on the other side of the curve in May. That's pretty good news. It means you won't quite have an all clear by Memorial Day, but by far the worst will be over. So we are going to have a big hole in the second quarter. There's no question about it. Our estimate is that you're going to see a minus 5% print in terms of GDP for the second quarter, that's a whopper of a hit. The problem and the challenge we have is twofold. One is to make sure that people, you know, who need it get cash, but more importantly, that those businesses that get hit hard have enough cash to reopen their doors. Mm-hmm. You could have what is sort of an inevitable 1 quarter or 2 month decline turn into something more extended where we don't come back.
Exactly. Because
a lot of businesses simply don't have the cash to operate. And I think that's what's been neglected. It was certainly neglected in the House bill, and I wish that is what happened. I think administratively, the easiest way to have done that would have been a payroll tax holiday because it shows up immediately in the small business cash flow. But so far, that hasn't happened.
Right. No. So we have an unemployment rate of 3.5% right now. Do you think it goes over 5?
It could go over 5. I right now my guess would be 4.5, but it certainly could hit 5. But if we come back and reopen and a lot of businesses don't fail, that number is going to come right back down again.
Sure. Yeah.
Remember, the biggest challenge that businesses had up until like 3 weeks ago was finding qualified workers. So certainly the demand is there for the workers. As long as the businesses, and particularly the small businesses who don't have capital, are able to reopen, that's key. And we have to find a way of getting money to small businesses and not just individuals, although the individuals are important.
Absolutely. So, Larry, because we're going to run out of time, let me ask you this. So your ideal, you'd say, look, you can quickly get money to small businesses by doing an employer-side payroll tax cut. Why not do an employee-side tax cut, too? And I know at this point we're talking about $1 or $2, maybe $1 trillion worth of action here. Are you concerned about, what that means for debt deficit and all that in the long run, or no? I mean, kind of walk us through how much this would cost and what that does to the U.S. in terms of any harm you're worried about, if you even are.
Sure. A 1/4 payroll tax holiday. So you don't pay payroll taxes, either employer or employee, for 3 months, is a net cost to the Treasury of about $300 billion. So that's rather small comparison to the 1 to 2 trillion people are talking about.
Because that would be for the
now,
year.
At this point, you're probably going to have to do more than that. If you'd done that 2 weeks ago, I think we would have had enough reassurance in the market. We wouldn't be needing to do more. But certainly it is administratively the quickest way because it's immediate. It's just a matter of changing your the size of the check you send to Uncle Sam, right? You can reduce it. And your payroll company can, click 3 keys on a keyboard, and there it goes. It's all set. So that by far is the quickest and most targeted way of having it happen. I think we're going to have to do that, plus something broader, given that we're acting on this all rather late. Why didn't it happen? It didn't happen, I'm afraid to say, because of politics.
Sure.
And remember, even travel bans were called racist back in January. And then we had impeachment, and then we had primaries, and I think the political system is just now waking up to just how bad the economic threat is.
Well, and hopefully they will take heed of what you're saying now if they didn't before. So again, suspend both sides of the payroll tax cut, $300 billion for a quarter, and maybe that could still help us out of this. Plus, like you said, something bigger behind that. Larry, thank you so much today. Greatly, greatly appreciate it. Thank you, sir.
Thanks for having me on. Take care.
Larry Lindsay is the CEO of the Lindsay Group. Going to take a quick break here. Coming up, it's more pain for retailers as many shut their doors to slow this outbreak. We are going to look at who could lose the most and who may be able to withstand the pain. We have some big declines today, gap down 26%. Plus, the Chamber of Commerce sending a letter to Congress about their plans to get small businesses back on track. We'll speak to them next. Dow's down 2,153 points. Welcome back. Take a look at shares of Clorox today. One of the few winners at more than 4%. JP Morgan upgraded the stock to overweight from underweight. The firm citing higher than expected demand for disinfecting products, trash bags, salad dressing, and charcoal as more consumers stay home for longer during the coronavirus outbreak. Their price target goes to $185 from $153. Clorox at $175 today. Speaking of the consumer, major retailers across the country are shutting their stores or reducing store hours amid this pandemic. Courtney Reagan is at the NASDAQ with a look at this growing list for us. Courtney.
Hey, Kelly. So, this is a very fluid situation, and it's going to keep changing. Soon, we might just say nearly all retailers are closed. It's starting to feel like that. It's just going to be the new normal in a country where officials are asking us to limit public gatherings, encouraging social distancing, and even imposing some curfews or shutdowns in some cases. So some retailers that are closed, for the most of them, it's about 2 weeks. Apple, Nike, Under Armour, Lululemon, Levi Strauss, Abercrombie, Urban Outfitters. Then you've got smaller names like Warby Parker, Everlane, Allbirds, and Away. Retailers, though, have said that employees will continue to be paid while stores are closed. In some cases, though, that only means if the employee had previously been scheduled. It's sort of case by case. Now, some retailers are shortening their hours. These are mainly the grocery stores, the type that need to restock and clean. So these would include Walmart and its neighborhood markets, as well as its Sam's Clubs, Publix, Stop and Shop, Natural Grocers, Wegmans, Trader Joe's, and some Kroger stores as well. Gap, Old Navy, Banana Republic, they're also operating under reduced hours. Now, for the most part, e-commerce sites still up and running, and supply chains are largely intact, but it does remain to be seen if that can hold up as the outbreak spreads and distribution center and delivery workers are unable to get to work. Now, some lost store sales certainly could get made up online, but likely it's far from the majority. It's going to vary by retailer, of course. Think about an off-price name like TJX, Ross Stores. They have been retail standouts, but they don't have big e-commerce operations, so those could actually be losers in this scenario. Analyst estimates are trickling out to try to quantify really the financial impact of these closures. Some are cutting full earnings guidance or full earnings estimates, I should say, by as much as 20%. And again, Kelly, going to vary by retailer. Piper Sandler saying Nike may only get hurt by about 2% its earnings from the closures, at least as they currently stand.
Right, it's changing quickly. Courtney, thanks. Courtney Reagan for us. The U.S. Chamber of Commerce asking President Trump and Congress for help as businesses deal with shutdowns across the country. In fact, the group's sending a letter to Washington outlining 3 actions they'd like to see right now. Joining me on the CNBC Newsline is Neil Bradley. He's Executive Vice President and Chief Policy Officer at the U.S. Chamber of Commerce. Neil, welcome. Real quickly, if you could, what are those 3 actions?
Well, thanks for having me, Kelly. Yes, 3 quick things. We want to make sure that employers across the country can continue to support the employees, just like the retailers you were just talking about. 3 things that we can help them do that. One is to suspend and cancel the remittance of all payroll taxes for the next 3 months. That'll give an additional $100 billion a month to employers to help them continue to pay their workers. 2, for America's small businesses, we need to immediately give every small business in the country access to the emergency disaster lending program set up by the SBA. We can remove all the roadblocks to get there and streamline the process. And for America's largest employers, we need to work with the Federal Reserve and immediately create a credit facility that gives those larger employers access to the financial liquidity they need to continue operations. So we have a simple principle at the Chamber. No individual and no business should go bankrupt simply because of a disruption in revenue during this crisis.
Sure. So really well and succinctly put, Neil, we appreciate it. So again, sir, we're all on the same page. The first, which we just talked to Larry Lindsay about, is suspend the payroll tax remittance for a month, maybe he said 3 months, give small business access to Small Business Administration emergency loans. And then the third I want to follow up with you on, for the larger employees, it's giving them access to the Fed's credit facility. How big do you have to be to get access to that? And what happens to those who are kind of medium-sized or caught in the middle here?
Yeah, so what we're suggesting is that the Federal Reserve and Treasury work with America's banks to create a loan and loan guarantee credit facility that would be available to every employer with 500 or more employees. So the small business loans would be available for those with less than 500 employees. This credit facility that would be established, similar to what we did in 2001 and 2008, would be available for the larger employers.
Okay, so again, working with the Fed. Now, does Congress have to act on this, Neil, in order for these programs to get up and running?
They do. Restrictions
Hoping you wouldn't have to say that. Yeah.
I know. Yeah. The restrictions that they put in place in 2010 make it more difficult for the Federal Reserve to create that credit facility. They need to loosen the rules on the SBA program. And obviously we need Congress to cancel the collection of those payroll taxes so that employers have it to keep paying their employees.
Okay, Neil, thanks. We'll continue to follow this story. Neil Bradley is EVP of the Chamber of Commerce. Thank you, sir. Coming up, we'll take another quick short break. Netflix down, it was 3%, now it's 7% in this session today. We're going to talk about how it's held up relatively better amidst the downturn so far, but it might not last. We're going to explain why next. And here's a look at the markets more broadly today. The Dow drifting lower. It's down 2,100 points. That's a 9% decline for the blue chips and for the NASDAQ. Just about that amount for the S&P 500, down 242, under 2,500. We'll be right back. Welcome back. Some breaking news on coronavirus. Canadian Prime Minister Justin Trudeau is right now updating Canadians on the measure his cabinet is taking to combat the impact of coronavirus. Get this. He just announced Canada will be closing all borders to non-citizens and non-residents. There will be some exceptions to this ban, including for some U.S. citizens, but a drastic move taken by our neighbors to the north, who in some cases have been criticized for not doing more quickly here. And again, a reaction to the reality of how quickly coronavirus is spreading in this country, too. Canada closing its borders to non-citizens. We'll have more for you as we get it. In the meantime, Netflix has performed far better than the market year to date. The S&P 500 down over 20%. Netflix only down about 3%, but it might not all be roses, and it might not be as coronavirus proof as you think. Julia Borston has more for us. Julia.
Kelly, that's right. People staying home may be streaming a lot more Netflix, but that doesn't mean that the stock is necessarily coronavirus proof. Needham's Laura Martin saying coronavirus is a negative for Netflix because the streamer does not benefit from an increase in viewing hours due to its flat free subscription and due to its lack of advertising. She says Netflix's international growth is at risk because of rising unemployment, and she notes that Netflix has a junk bond rating and negative free cash flow. Now, on the upside, Netflix's most popular $13 a month plan may seem more worthwhile if people are spending hours streaming it at home. But on the downside, Netflix is about to face 3 new rivals, which will offer free trials. Quibi is set to launch April 6th, HBO Max launches in May, and then Peacock will roll out nationwide on July 15th. Now, HBO Max is the only one of those services that will cost more than Netflix, but it will be free for current HBO subscribers. Kelly, back over to you.
Yeah, I saw Disney. What are they doing? Frozen 2, Julia? I mean, there's some effort out there to say, hey, you know, we understand you guys are stuck at home.
That's right. Disney releasing Frozen 2 several months early on Sunday. And also remember, Disney Plus launching internationally, launching in Europe, which is expected to be a very big market on March 24th. So the question really is whether these are seen as valuable services that people are willing to pay up for because they're stuck at home.
Right. Julia, thanks. We appreciate it. Julia Borston, the Fed's emergency action over the weekend appears to be taking its toll on the banks. Look at these price moves today, the worst performing sector and the second worst performing sector this year. They're all under pressure, all the big ones. JP Morgan, Bank of America, Citigroup. Citi was down as much as 20% earlier, about 16% right now. As you can see, JP Morgan down 12.5%. Regional banks not spared either. One of the ETFs that tracks those names, the KRE, has fallen more than 40% since January. The largest regionals like Fifth Third, KeyCorp, and Truist are all down 15% today. Now, the slowdown we're seeing in the economy has many wondering when, not if, we'll fall into recession and how long that will last. Joining me now is Torsten Slok. He's the chief economist for Deutsche Bank Securities. Torsten, you always have such great data. So what's your best summary of what you think is happening to the economy here?
So it's, of course, really difficult to quantify. But one thing that we did try to look at was to go back and look at how long time did the recession last in 1918, 1919, when we had the flu pandemic. And the NBR data shows that at the time, the recession lasted about 7 months. In other words, it was a relatively short recession. Normally, a recession in the U.S. lasts about a year. That doesn't necessarily mean that it will be the same length this time, but it does tell you very importantly that this, at least relatively, last time we saw this, it was a relatively short affair compared to how normally recessions are, about a year or a little bit more.
Sure. And we have your great chart, which shows the length of recessions since 1918. There's not a single one on here under 6 months, and this 6 months has an asterisk because 1980-81 was a double dip. So let's just call that one 22, meaning the shortest one really would have been that 7 months in 1918 or 8 months in 1990 and 2001. Here's my point. Right now, a lot of the forecasters only have one negative quarter, the second quarter. That's 3 months. Is there any way the U.S. can get out of this with only, let's say, a 3-month downturn, or does that not count because then that's technically not a recession?
Yes, so that's exactly right, Kaylee. I mean, the risks are rising, of course, that we will have a recession that will last 2 quarters here, which is the technical definition of a recession. But what's really unique about this is that normally a recession comes around because there's some imbalance in the economy. For example, in 2006, there was an imbalance in the housing market. In 2000, there was an imbalance in the IT sector. In 1990, there was an imbalance in commercial real estate. So that imbalance needs to be worked off, and that's why it takes time to get through this. We really didn't have any imbalance that triggered this. This literally came out of the blue. So that's why this could be turned on as quickly as it was turned off. So that's why we are relatively optimistic that this will be deep but short, because simply there is not the same type of endogenous or homegrown reason why we're seeing this slowdown.
You know, I wonder, too, Torsten, like you said, a lot of times we talk about recessions as needing a certain duration, usually about 6 months. If this is sharp enough, do you think they'd count it if it were less than that, or if it was 1 quarter, maybe a rebound another quarter? I mean, there's a lot. And again, I'm not trying to get hung up on what the definition of this is. No matter if it's a recession or not, it's a terrible event for people. It's just we're trying to understand how this might play out because we really haven't been through something like this in recent history.
Absolutely, Katie. I mean, what you just spoke about in terms of stores closing, I mean, literally, this is 100% decline in sales and 100% decline in around the economy, consumption in capex. I mean, that's a very serious event relative to any of the more gradual adjustments that you've seen historically. So absolutely, we really don't have any precedent as such for figuring out, other than trying to go back and look in history at how long time this normally takes when you have a normal recession relative to this very, very unusual situation that we're in at the moment. But good news is that, of course, policymakers, including, of course, the Fed, but also fiscal policy, are doing everything in their power to try to flatten out not only the curve in terms of infections, but also the curve in terms of limiting the recession.
Torsten, what do you think is the single most important data point for markets at this point?
I really think that there are 2 things that are absolutely critical to look at. We need to flatten the curve, or we need to see a flattening of the curve of new infections. There's a lot of issues going into testing, but also to flatten the curve in terms of death. Obviously, it's very unfortunate that we're seeing this situation where in some countries it's still going up. So the number one thing that we're watching is we need to see the second derivative in terms of new infections to start to get better. And unfortunately, as you know, in Italy and elsewhere, the lockdown, we really haven't quite seen yet that second derivative improve. That's why markets are so much on edge. And the second thing we're watching is really the policy response. We need to figure out, not only from the Fed, but also fiscal policy across countries, what is the right design? What is the right way to limit the negative impact on the economy? Exactly as you were just debating in the previous segment, there are various ways to do this, but this is the absolutely critical point that we need to see a very, very strong pushback on the negative consequences on the economy.
Okay, Torsten, thanks. We appreciate it today.
My pleasure.
Flock of Deutsche Bank. As we mentioned, the markets today are off their lows, but we're still sinking more than 2,000 points for the Dow. The regional banks, the banks in general, among those hardest hit today. Here's Valley National down nearly 12%. We're going to talk to the CEO about this straight ahead. Don't go anywhere. CNBC's breaking news and special coverage continues on the other side of this break.
Good afternoon, everyone. Kelly will join us in just a moment. I'm Tyler Mathisen. Welcome to Power Lunch. We continue with our breaking market coverage at this hour. The Dow crashing yet again today, down more than 2,100, almost 2,200 points right now, despite major emergency action from the Fed as corona cases in the U.S. grow and cities and states start to shut down businesses. And the big banks are getting crushed today, the worst performing sector of all today. Take a look at these here, Valley, Regions, PNC, and KeyCorp. Citi with the most international exposure, down about 18%. Regional banks, there you see them not being spared. We're going to talk to the CEO of Valley National, which is falling double digits, as you see right there, 12%. He'll be with us, Kelly, later this hour.
All right, Tyler, thanks. And here's what you need to know, everybody. There are now 3,800 cases of coronavirus confirmed in the U.S. New York, New Jersey, and Connecticut are banning all gatherings over 50 people, and they're closing dine-in restaurants and bars following that recommendation from the CDC. Finally, U.S. airlines are seeking $50 billion in government assistance, and if approved, it would be the industry's first broad bailout since after the September 11th attacks. And we've got full team coverage of this market sell-off this afternoon. Bob Bassani is monitoring conditions at the New York Stock Exchange. Rick Santelli is out at the CME watching the bond market. Steve Leisman is all over the response from the Federal Reserve. Bob, we'll begin with you.
Third trading halt in the last 6 trading sessions, Kelly. That's this morning, right after the open, 9:30 or so. 15 minutes, the S&P down 7%. These trading halts have at least served to slow the markets down a little bit and do put a little bit of brake on things. We didn't stop us from dropping down about 10%. You can see off of that, 24.09 was the low for the day. We'll keep an eye on that. We are continuing to see this bifurcation in the market. This happened about Thursday last week. It's even more noticeable today. You see banks, tech and industrial cyclical groups generally underperforming the market, where defensive groups like healthcare and consumer staples generally outperforming. This has been the trend ever since roughly Thursday here. Market gainers here, if you look at some of the consumer groups largely, Rite Aid, for example, says they're working with the White House to offer testing in car parking lots. Kroger's been doing great recently, understandably. Clorox just got an upgrade from JP Morgan. Campbell Soup, another consumer name that's also been holding up very well for understandable reasons. Some are calling for a trading holiday. We ought to stop for a few days or a few weeks. Stacey Cunningham at the NYSE says no, and she's one of many people in the business calling not to close the markets. It's important for the markets to remain open, she tweets this afternoon, and for them to function in a fair and orderly manner as they have been. Of course, that's been a big debate down here. She says closing the markets would not change the underlying causes of the market decline, would remove transparency into investor sentiment, and reduce investors' access to their money. This would only further compound the current market anxiety. Mr. Mnuchin, the Treasury Secretary, reiterated that on Friday. He, too, is opposed to closing the markets. Finally, just note, here's the new normal. As I walked in this morning, this is what I saw at the NYSE. People coming up to us, checking our temperature. If you worked on the floor, fill out a questionnaire. You feeling okay? Got a fever? You've been outside the United States recently? This is what the world looks like now. Guys, back to you.
All right, Bob, thank you very much. Yields have been dropping sharply again today, and Rick Santelli is all over the action at the CME. Hi, Rick.
Hi, Tyler. Yes, we had 4 sessions where both the dollar and interest rates were higher. Well, looks like we're going to break on both of those. If you look at 10-year note yields on this chart, you can see we're visiting the low end of today's range as we hover around 73 basis points. A month-to-date chart gives you all the info you need. Minus 54 is the low close from a week ago. The low intraday yield on the 9th of March was minus 31. You want to keep those 2 numbers in mind. The yield curve is flattening. We've lost almost 9 basis points today, 10s to 2s, most of that at behest of the long end. So you really want to pay close attention. As for what's going on in high yield, well, we have a surrogate for that. Let's look at the HYG. Right now, it's at the lowest yield since February 2016. Zoom, 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 all the way back to the March 2008, of course, the credit crisis. That is the definitive historic marker for that. And, of course, these spreads on HYG are wider, but investment grade is behaving rather well, all things considered. Hey, the dollar index is actually up a little on the year, about 1.4%. Let's look at the component parts. Euro versus the dollar, down a bit. That's a year-to-date chart. And finally, the dollar-yen. Dollar definitely down a bit. It's settled at 108.60. It's hovering right now around 105 3/4. So losing some ground on that safe harbor trade. Kelly, back to you.
Okay, Rick, thanks very much. Rick Santelli. Now, the Federal Reserve cut rates to zero with an emergency move yesterday and launched a $700 billion stimulus plan meant to help the market, but it's really spooked investors over how bad things could get for the U.S. economy. Steve Leisman has those details and more for us. Steve.
Kelly, thanks very much. I've been trying to gauge all day, talking to senior bankers at different firms all day, the response to the Fed's emergency actions last night, and the answers are not good. The best thing I heard was it will work, it will take time. But I asked somebody else, they said, is anything better today in terms of being narrower in spread? And the answer was no. Let me tell you some of the issues about the markets remaining on edge. Point number one I've heard out there, some U.S. funding markets still not functioning smoothly. That led the Fed to do an unscheduled $500 billion overnight repo, a second one during the day. There wasn't much take up on that, which may be good news compared to the morning where they took down 129 billion. The afternoon they took down only 19. Huge submissions for these Fed Treasury purchases. As we described all day, the Fed is in the market during the day in a series of purchases of $40 billion of Treasuries and mortgage-backed securities. But the market continues to call for the Fed to do more. We're hearing repeated calls for the Fed to get involved in the commercial paper market and other directed lending that needs to be done, perhaps to certain industries. One of the things that we can tell you guys is the outlook for the U.S. economy now has changed dramatically. We did a Fed survey over the weekend. Now there is a 67% probability of a recession in the next 12 months, and that is up from a 41% already elevated in January. That is the highest probability we've had in the 10 years we've been asking this question. Now I want to walk you through the outlook for the 40 respondents for growth by quarter, and what you see is a modest first quarter, not really a big hit in the first quarter, but now look at the second quarter where you have a big negative there of minus 1.8% on an annualized basis, going flat in the third quarter, and then finally you get a rebound in the fourth quarter. This is upon available information. And now I hate to provide even more news, but the forecasters at the UCLA Anderson forecasting shop there, they just put out a release saying the U.S. may already be in recession right now, according to their gauge of the economic data. Kelly?
Steve, I have one follow-up question for you. So the Fed today said it was going to do about $500 billion of repo, that kind of emergency liquidity or funding. Then came the news that they accepted just $19 billion worth of bids. So they offered $500 billion and only $19 billion of it was taken up. I mean, what does that tell us?
Well, let me go back because, that was the second offering. So they actually offered $1 trillion in repo today, as you know.
Wow.
And in the morning, they took up 129. So I wouldn't get hung up on the 500 billion number. 500 billion is a Fed proxy for infinity offering.
Okay.
We will offer you as much as you need. That's the way to think about 500 billion. They don't mean 500. They don't know if 500 is needed. 500 is their gauge of the most ever that the market could need, so that there's as much ample supply for the repo market as may be needed. So the 19 is a good sign. It is not a good sign the Fed felt a need to come in with a second repo action or auction today. But it may be a good sign that in the afternoon they only took down 19 billion. We're going to have to watch these markets. You're going to have to be on the phone talking to people who are saying, look, some of these markets are broken. And in the way to think about what the Fed did last night, Kelly, is really focused on getting these markets to work, because at the end of the day, nothing really matters if the U.S. dollar funding markets aren't working.
No, great info, Steve. We appreciate it. Thank you so much, sir.
Alrighty, stocks are plunging today despite the Fed's drastic action that Steve just described. The market on track for its worst month since October of 1987. For more, let's bring in Mark Lucchini, Chief Investment Strategist at Janney Montgomery Scott, and Victoria Fernandez. She is Chief Market Strategist at Crossmark Global Investments. Mark, on Friday, or you characterized Friday bounce as powerful but impetuous. Its legitimacy will be tested, you said. You were right. This is a test of its legitimacy.
Well, it sure is. In fact, we're basically giving back the gains that were made on Friday, and we haven't even closed yet for the day. So obviously it's disappointing to see that. It would have been nice to see if we could have some carry through into this week, albeit perhaps not as sizable, but nonetheless at least holding its own, particularly with the Fed intervening the way it did yesterday. But the fact is there's a bull market in uncertainty at the moment, Tyler, and until we have some handle around when the number of cases is going to at least begin to decelerate, the market's going to continue to search for a bottom, and we're going to have to live with these bouts of volatility for good or for bad. Now, the market is tremendously oversold at this juncture, which implies we could, on any day or hour, see a rather significant ricochet rally. But again, its legitimacy will be challenged by way of any kind of persistent follow-through, unless, of course, we get confirmation, even perhaps starting in Italy, that the number of new cases being reported begins to subside.
That's a good question, Victoria, because obviously there's a monetary stimulus in the system now. There is at least some fiscal stimulus coming in the form of the package that was moved through the House on Friday night. But it would seem to me that you don't get a market to turn around on just those two things, though they can be very helpful, in this particular and peculiar case, you need to see some progress on the health front before people have any confidence to go out and buy new cars and do anything other than go to the grocery store and load up on staples and paper goods.
No, you're exactly right, Tyler. I mean, the Fed is not here to solve the health crisis, right? The Fed is here to ensure that the markets are functioning properly. So the injection of liquidity that they did is exactly what's needed. We saw illiquidity on our trading desk this morning as we were trying to address some of those measures. But we really need to wait and see here in the U.S. when these cases get to that peak number. Once we see the cases peak, once we see those cases then start to decline, some of the fear and the panic that we're seeing in the markets will begin to subside. At that point, things that the Fed has done will come into play more and allow it to be maybe a stronger recovery than we would have had otherwise. But we're not going to see the market stabilize until the health issues and that peak number of cases is reached.
You know, Mark, the Dow has lost roughly a third of its value. The Russell has lost more than that. Can you envision a situation where it loses another third of its value?
Well, Tyler, obviously in this environment, anything is possible. However, you mentioned a third, and that happens to be roughly what we typically see in the drawdown in the equity market in or coincident with a recession. So in my view, at this point, equities are presenting a compression in valuation and price that largely have pulled forward the odds of a recession, which are increasing, as Steve, of course, talked about, and seems likely we're going to have at least one negative quarterly print, if not successive. And so I think perhaps while we still could see lower levels from where we're trading today, I think investors should be at least beginning to leg into certain very high quality franchises that have been sold off indiscriminately in this environment, because I think 12 months hence, they'll find it to have been very rewarding.
Begin to leg in. That suggests do it gradually, kind of dollar cost averaging your way in, because you'll never hit the bottom, right, Mark?
Most definitely. And like I said, we can't say for certain that we've bottomed, but we may be at least bottoming, or at least the process thereof. And as a consequence, I think it's very difficult to go in all in and, shoot your ammunition when there may be even a better opportunity that lies in ahead in the forthcoming days or weeks.
Are you starting to nibble, Victoria, or not?
We did start to do that towards the end of last week. I think you can find some opportunities in this market of names that are strong names. They have strong balance sheets. You know that they're going to be able to ride through this, and this would be a good opportunity to start adding to your portfolio. We did it with some existing names like Apple, Amazon, Microsoft. Those are all names we added to and actually brought in new names. ServiceNow is a name that we just brought in our equity portfolio. It's cloud reporting, and we know that with companies moving more and more towards people working at home, and this is a great test of that for companies around the globe, we're going to see more opportunities there. So look for companies that could not necessarily take advantage of the moves in the market that's going on right now, but that potentially will come back and be stronger.
All right, folks, we have to leave it there. Mark Lucchini of Janney Montgomery Scott, Victoria Fernandez of Crossmark, we thank you. Kelly.
Now, today's sell-off is triggering circuit breakers again this morning, freezing trade for 15 minutes. And that makes it the third system-wide trading halt so far this month. It has been a wild March for the markets, with 7 days of 1,000-plus point Dow moves so far. Joining me now to make sense of it all is Terry Duffy. He is the chairman and CEO of the CME Group. And Terry, Rick's not down there on the floor. You guys closed that up a couple of days ago. And as we continue to see everything from gold to Bitcoin to copper under pressure today, what do policymakers need to know about this market action?
Well, I think policymakers need to know a few things, and I think we need to have coordination, Kelly. I know that a lot of people are saying maybe the market should shut down, so let's talk about that for 30 seconds or less. What's important is you don't know if you're going to have pent-up demand for buying or pent-up demand for selling once that comes off. Everybody has said on this show, and they've said it historically, we don't know what the numbers are going to be, so it's really difficult to predict. So what I think would make really good sense is to have the marketplaces tighten up its circuit breakers. Today, as you know, it's 5% overnight, and then it goes 7, 13, 20, and after 20, you're halted. I think we should go 7, 13, and halt. Wow. Either that or we should go 7, 10 and halt. But we should not close the marketplaces because we don't know what's going to happen.
Terry.
So I'm not talking my own book. I'm actually thinking that we tighten it up a little bit.
Sure. Before we even continue, let me just stop you on this thought. Why? So why these circuit breakers were instituted several years ago? What is it about the trading behavior today that tells you we shouldn't let markets go that 13% or that 20% down in one session? Certainly, are you basically saying the liquidity has gotten so bad that the circuit breakers need to be tightened up?
No, Kelly. Not saying that. We are dealing with something we have never seen before. We're not dealing with the financial crisis as you and your guests continue to talk about. We're dealing with something completely unknown. And when you deal with unknowns, you should look to tighten it up to make sure that the public has an ability to manage their risk, but at the same time not let their risk run wild. So that's the reason I'm saying that, not because of illiquidity. We're doing $1 trillion a day in notional in E-mini S&Ps every single day. It's not the liquidity, Kelly.
So here's what I'm trying to understand. What would tightening that up accomplish if you're saying, look, we don't want to close things. We want to make sure that people are, if it wouldn't accomplish anything, why do it then?
No, Kelly, it would accomplish a couple things.
Okay.
You have a lot of people, including Scott Wapner, who works for CNBC, tweeting that the market should be closed. My point is that would be wrong to close the marketplace. There's a lot of people in Washington don't know what to do. They think maybe should they close the marketplace. That's wrong. What you should do is just tighten up the bands for now during this very stressful period, but yet don't close them. And then also, you have ETFs, Kelly, as you know, that are trading outside of these bands that are becoming leading indicators. How is this even possible? Do not be in coordination with the overall equity market. So, Kelly, what I am suggesting is that we all be in coordination, but we might just need to tighten this up a little bit to take a little bit of the volatility out of the overall market, not shut them down, tamper the volatility.
Now, that's an interesting point, too. So we've all taken to watching the Dow, the S&P, the triple Q ETFs to the NASDAQ as a proxy for, hey, if the markets were open, this morning was a great example. I'm looking at futures halted and saying, OK, I get it. They're halted down. I think it is 5%, but the Dow would be down 11% right now. And I can see that because that ETF trades as of 4 a.m. Are you saying that in order to make sure that, what's the point, effectively, we should not allow for those ETFs to trade and kind of give us the information anyway? It kind of undermines the point of having the futures halted, or not halted, but again, price limited.
You got to coordinate with the underlying securities markets, futures markets, and other things. You cannot have the ETFs, which are highly illiquid, determining what the overall multi-trillion-dollar U.S. equity market is going to do. That's my point.
So, Terry, let me get this straight. So you're saying there is no, so I'm sort of thinking about it from policymakers' point of view here, there is no liquidity problem. You're saying you're seeing a ton of action in terms of people showing up to trade, price discovery, it's working. But you're saying for the general public that, maybe a way of taking some of the pressure out of and the volatility out of this situation is just by having trading halted if we hit something like 13% instead of 20%.
That's all I'm saying, sir. I am saying that don't close down the markets because you don't know what's going to happen when you reopen them. Everybody thinks that the waters will be calm and will open straight up. I mean, maybe that is the case, but it's a very big risk to take. And because there's so much money being managed passively versus actively, you don't know if you're going to hit a massive amount of stops with all this passive money sitting in the market that hasn't even transacted yet in the overall market. They have different levels. They're not actively managing their portfolios like they used to. So I don't know what the case is, but I do know one thing. You should at least leave the markets open so people can transact, but at the same time, be responsible about it during a time of crisis. This is not 08, Kelly, as everybody is saying. This is a virus of which you, me, and everybody else knows nothing about. We're not MDs, and we should let the professionals tell us what to do. And at the same time, we should at least think about coming up with some new solutions so people can transact business.
Yeah. All right, Terry, thank you. Thanks for joining us today.
Thanks,
Terry
Kelly.
Duffy,
Appreciate it.
CEO of the CME Group.
Well, the airlines are under pressure as more global travel bans are put into place and demand drops sharply for domestic flights. Let's go to Phil LeBeau for the latest details. Hi, Phil.
Tyler, there is no indication when demand will rebound and when people will start booking flights as opposed to canceling them. As you take a look at the major U.S. airlines today, most of these stocks are off of the low of the day. Now, they did come back about an hour ago when the industry's trade association says, look, we're looking for an aid package out of Washington of between $50 and $58 billion. No indication whether or not that is going to be received enthusiastically on Capitol Hill or whether or not this is just the beginning of a negotiation. When you look at specific stocks, take a look at United Airlines. And the reason we're showing you United is because last night they said we're going to cut our capacity by 50%. But it was the message from CEO Oscar Munoz that really stood out. He was very blunt. He said, the worst is yet to come. We do not see this getting better. Day by day, it continues to get worse in terms of demand. And it's not just here in the U.S., by the way. As you look at international carriers, especially those in Europe, take a look at Ryanair. They're talking about grounding the majority of their fleet within the next week. And that's because you've got a number of countries over there, whether it's Poland, whether it's the Ukraine, etc. They are saying we're not taking in flights from outside the country's borders. As a result, an airline like Ryanair is looking at grounding its fleet. And also Virgin Atlantic, which is 49% owned by Delta. Virgin Atlantic is suggesting that it may be giving unpaid leave for up to 8 weeks to many of its staff members. So guys, we're in the midst of seeing the airlines trying to come up with two things. One, a way for their governments to help them out through this crisis. And two, whether or not they have to look at cost cuts or furloughs.
Offered 8 weeks of unpaid leave. That doesn't sound like much of an offer to me, Phil, to be honest with you.
No, but what's your alternative? Okay, well, we don't need you anymore. We're going to furlough you, or we're going to lay you off. I mean, it's a tough choice if you're an employee.
It basically is an 8-week furlough.
Sure.
But so what other measures are you seeing airlines take to combat what's been going on with the virus?
Sure. Well, I think one of the more interesting things is that the airlines are trying to convince those who are still flying that, look, when you get on a plane, and we've seen all of these reports of, well, it's not safe to get on a plane, coronavirus is floating around, they don't wipe down these planes. Look what Delta does. Delta has hired a company out of Boston. It's called Earth Safe Chemical Alternatives, and they essentially spray a chemical that it's a disinfectant on the aircraft. And we talked with one of the executives with the company earlier today in the parking lot at CNBC. He gave us a demonstration, and he basically explained how this works.
One of the benefits of this technology is how fast it can actually disinfect an airplane. It takes just 3 to 4 minutes from start to finish. The chemical requires just 1 minute contact time to kill coronavirus effectively. And the benefit there is that they can use it to disinfect the planes not only in the evenings, but also between every turn. And it takes just minutes until the passengers can reboard the airplane.
Perhaps one of the more interesting things is that when we first reached out to this company, Tyler, our producer Megan Reeder reached out to them. They were like, well, we're not really sure people want to talk about this. Now the airlines and other companies are saying, yeah, we want to let the public know that we are disinfecting not only aircraft cabins, but other companies that are using this technology.
Fascinating stuff. Phil, thank you very much. Phil LeBeau.
Well, the Federal Reserve took some drastic emergency steps last night. Hasn't done much to calm markets today. The stocks are down about 10% for the Dow. Remember the session lows. Dow was down about 2,800 points. We're not back there quite yet, but we are still down more than 2,000 points at this hour. The Russell 2000s are down nearly 12.5%. And the last time the Fed kept rates at zero, says my next guest, the policy failed. He fears coronavirus shutdown in the U.S. Could tip off a second Great Depression. Joining me on the phone is Chris Rupke. He's chief financial economist at MUFG Union Bank. Well, Chris, as pessimistic as they always say the bond guys are, listen, we were just speaking about an hour ago to Torsten Slok about whether we're going to see maybe 3 months or 6 months or 7 months of negative GDP. You seem to be talking about something quite worse than that. What do you see?
Well, I may have engaged in a little hyperbole, but yeah, the world's running that way at the moment. I'm shocked that some of my colleagues on Wall Street are already calling for real GDP to fall 5%, 5 percentage points in the second quarter. It shows you how extreme this has gotten. So put it this way, if growth this quarter, we're not even going to get growth until April for the first quarter. If growth is unchanged this quarter, down 5% in the second quarter, up 1%, third, up 2% the fourth, then GDP will fall this year 0.5% as the Fed measures it. And looking back to the 80s, it's only fallen 2 other years for the whole year like this. So it would be dramatic, but I'm hopeful that this is like a coronavirus recession. In other words, it's not a standard recession where it can build on itself and the job losses can build and there's a downward spiral when your neighbor loses a job. I'm hopeful that because it's a virus, once the economy gets over the virus, activity can come back faster than we're thinking. That's my hope. I'm trying to be a little more optimistic now that I'm losing so much money in the stock market today.
Well, and one thing, Chris, I think, if you'll wax philosophical with me for a moment, is worth reflecting on. There's a reason why you're hearing a lot of people call for, $1,000 checks to households or what have you, who wouldn't normally be in favor of that kind of policy. And that's because there's a big difference between a recession that comes on because the economy is changing and needs to go through creative destruction and the business cycle is ending. That's one kind. I mean, this is the kind where things were kind of chugging along and something comes and hits you out of the blue. Wouldn't you say the policy response should be different to an event like this than to something like 08, 09? So, in 08, 09, you want to punish the banks, for example, for being bad actors. This time around, you probably want to make sure that businesses who are kind of minding their own business, so to speak, don't have to go belly up because this happened to them.
Yeah, I hear you, but I think there's too much risk management at play here, where people are trying to get out in front of actual events much too early. For instance, I think the number of corona virus cases in New York I saw this morning was 950. It doesn't sound like it's the bubonic plague here. I think the lesson that the Fed has learned, or should have learned over the years, is when they come in early, very strong, it falls on deaf ears because people are running for the exits and don't really care. So in a way, they lose the ammunition. So these calls to do more and do fiscal stimulus, I think it's unwarranted. I think you want to see how bad the damage is first. Last month, we created 273,000 jobs.
Sure, and Chris,
It's
only because
it's too early.
Yeah, we have to go, but let me just ask you about this, though.
Yeah.
If we wait and see how bad the damage is, it's going to be worse. Because if workers and businesses knew, look, there's going to be a federal backstop for 3 months of interruption, they're going to have more confidence to keep their operations going and keep people on than if they don't have that assurance, right? So we can't really wait and see here.
Yeah, no, I disagree respectfully there. I mean, we have the example of the payroll tax holiday in 2011 and 2012. They gave the top earners basically $2,000 extra in their paycheck for the year. It did nothing for economic growth in 2011. The tax cuts did nothing for growth in 2012. It wasn't until 2015 that the economy came back. So I think this is premature here. I think people are watching the stock market, investors panic, and now Fed officials and policymakers are panicking too.
Yeah, no, that's sort of a not self-fulfilling, but one kind of feeding the other, we should say. All right, Chris, thanks very much. Chris Rupke phoning in today. Check back in with you soon. Be sure to catch CNBC's extended coverage of this market turmoil in our special report at 7 p.m. Eastern tonight.
All right, still ahead, the S&P Regional Bank Index falling more than 11% today. This after the Fed's emergency rate cut last night. We'll talk to the CEO of a regional bank here in the Northeast. That is coming up. And the volatility index spiking to its highest level since the financial crisis. The Nasdaq's head of North American Market Services will join us to discuss the ongoing volatility, what it means for trading and any upcoming IPOs. We will be right back.
Wentworth.
Welcome back, everyone. I'm Sue Herrera. Here's your coronavirus update. The number of confirmed cases reaching 179,000 today, with more than 7,000 deaths. The head of the World Health Organization says social distancing and other measures to limit contact between people can help fight the spread of the coronavirus, but testing people who might be infected is still the #1 priority. In Canada, Prime Minister Justin Trudeau announcing that that country will close its borders to non-citizens with the exception of permanent residents and U.S. citizens. Additionally, anyone exhibiting COVID-19 symptoms would not be allowed into the country. Trudeau noted these restrictions will not apply to commerce or to trade. Here in the U.S., the governors of New Jersey, New York, and Connecticut announcing today that all 3 states will ban gatherings of more than 50 people. And as of 8 p.m. tonight, all gyms, bars, theaters, casinos, and restaurants will close. Bars and restaurants will operate as takeout or delivery only. You can keep up to date on the coronavirus outbreak by checking out CNBC.com. Kelly, back to you.
All right. Sue, thanks very much. The oil market is closing up for the day. It's been another rough session with crude dropping below $30 a barrel. Eric Chemi has the latest for us. Eric?
That's right, Kelly. You can see all of the red behind me. Crude down 8.5%. Below 30 at $29 a barrel, and here's Brent at 30.3, down 10.5%. Brent also hitting its lowest level today since February of 2016. That's 4 years ago. The coronavirus obviously still taking its toll on demand, especially as more airlines and countries cut off travel. Supply is not helping the situation, with OPEC set to ramp up production after its talks with Russia and other allies broke down. Here on the U.S. side, President Trump saying Friday the Energy Department would purchase large quantities of oil for the U.S. Strategic Reserve. Reuters reporting today that those purchases could begin in as early as 2 weeks. Kelly, Tyler, back to you.
All right, Eric, thank you. Oil is coming off its worst week since the financial crisis, and President Trump announced on Friday a purchasing plan for the Strategic Petroleum Reserve. But our next guest says that bailout is not enough. Joining me now is Mike Summers. He's president and CEO of the American Petroleum Institute. Mike, welcome. And first of all, how bad do you think this is going to be for oil and gas production in this country as prices continue to plunge?
Well, of course, this is a disaster for many shale producers in particular, and we're watching it very closely. And we want to make sure that the oil markets remain well supplied. Of course, we're keeping an eye on all of our refineries. But this supply shock, particularly as a consequence of Saudi Arabia and Russia producing all they can produce, is really, really damaging to American oil markets.
Yeah, it's a double whammy. You have demand falling, and then you have supply increasing because of that dispute. So how much should we expect production to drop in the U.S., and what's that going to mean for big oil-producing regions like Houston, like Texas, like the Dakotas?
Well, I mean, to put this in context, API does a monthly statistical report. It's going to be released this Thursday. And in February, we actually saw U.S. refining throughput and exports set February monthly records. And U.S. crude production also sustained a record of 13 million barrels a day, which, again, is also a record. So as inventories went higher, it helped set the stage for these dramatic results when we saw this incredible surge that came online because of Saudi and Russia's pumping really to the brim. So actually what we're seeing in addition to that, and again, this report is going to be out Thursday, is that while we're starting to see downturns in demand of diesel and jet fuel, we've actually seen slight increases in demand for gasoline, which I think suggests that many people are driving instead of flying. So obviously that's going to go down as the demand concerns continue to increase.
That's a really interesting point about substitution. I want to ask you something wonky. I apologize if there's not, an answer at this moment, but we've seen the price of WTI and Brent narrow considerably. They're almost both trading about $30. They usually have a much wider spread. What does that mean or portend to you?
Well, importantly, we saw in February where the U.S. and international crude oil prices grew closer, but we're still about $5 a barrel higher for WTI. And with OPEC actions and further drops this past week, WTI is now at a premium to international Brent crude oil.
Wow. So does that put the U.S. producers in an even worse spot or better, or what do you make of that?
Well, look, I mean, U.S. producers are resilient. I think we're obviously continued to be concerned about their financial position. But this is an industry that continues to invest for the long term. They've made big financial decisions earlier. They've hedged a lot of their oil. So, look, this industry is going to continue to invest for the long term, and it's going to continue to sustain itself as a key driver of American economic performance.
Okay. Mike, thanks very much for joining us today. Mike Summers.
Great to be with you.
With API.
Restaurant stocks taking a hit as states move to ban dine-in eating and discourage large gatherings of more than 50 people. Let's check in with Kate Rogers for the details. Hi, Kate.
Hi there, Tyler. Cities and states across the country are taking steps to limit restaurant service, including California, Maryland, New Jersey, New York, and Connecticut, all announcing this morning that bars and restaurants will move to takeout or delivery only. Challenger Gray and Christmas warns that there are nearly 5 million workers in this industry who stand to be affected by layoffs or reduced hours, a number that will surely rise as this outbreak grows. Meanwhile, businesses are also stepping in. Starbucks temporarily closing company-operated stores in high social gathering locations, including malls and campuses, and reducing hours or closing stores in places like Seattle and New York City with high clusters of COVID-19. Instead, the company is moving to a to-go model for customers. Workers will be paid if their store hours are reduced. Chipotle is offering free delivery through the end of March, shipping its food in tamper-evident bags. And Domino's, its CEO, reminding customers it has a contactless delivery option. That company also getting an upgrade today from Stevens on expectations for performance during this outbreak as consumers shift toward delivery and carryout. Guys, and we should note that right up until we went on the air, Domino's was the only restaurant stock that was still positive year to date. It just turned negative, but we will keep an eye on it.
All right, Kate, thank you very much. Kate Rogers. As Americans flock to grocery stores to stock up on staples, Kroger, Sprouts, other chains have seen a major bump in business. As you see there, the stock price is reflecting some of that bump as well. Grocery chains, however, under pressure to keep up with the massive surge in demand with people hoarding specific items. The president held a call yesterday with grocery executives, and my next guest was part of that conversation. Joining us now is Anthony Hucker. He's the CEO and president of Southeastern Grocers. Mr. Hucker, welcome. I know that was an off-the-record call, but how did it go and what did you talk about?
Yeah, thanks very much for having me back, Tyler, to you and Kelly. As you mentioned, it was an off-the-record call, but really the president wanted to listen to us as to what we really needed. And the message in the conversation that certainly I passed on and on behalf of our associates is that after hospitals, the emergency services and elderly care facilities, we had a strong request to keep the grocery stores open because obviously we're serving a very basic need.
So you operate largely in the southeastern part of the United States. Are you seeing a bump in sales, and what categories are driving that bump in sales if you're having one?
Yeah, so the short answer to your first question is, yeah, there is a bump in sales. It is category specific, excuse me. Obviously, those categories like household cleaners, bleachers, hand sanitizers, toilet paper, everything around personal care. We've seen bumps in the region of up to 200% in some of these categories.
Yeah. I don't know whether you're having this, but I went into my local grocery today, and all of the paper products were gone. And many of the sort of staples like pasta were in extraordinarily short supply. Why do these shortages occur, and how long should one expect them to last?
Yeah, I think it's a natural human behavior when there's the fear of the unknown, Tyler. I mentioned last time we've had 4 Category 5 hurricanes in the Atlantic Basin over the last 4 years. So we've built a very strong muscle, especially around our computer-generated ordering systems, that we can change the fields in order to flex and meet that demand. But it's a consumer behavior that's centered around this fear of the unknown.
Sure, it's certainly a natural experience. What is it about the supply chain that could make it come back faster? In other words, why aren't stores up here able then to restock quickly?
Yeah, so we have an extremely experienced supply chain based on that muscle that I said we built over the years. and we're able to bounce back very, very quickly. I was talking with Terry Thomas from Unilever, and the big manufacturers, the demand is 130% of their actual capacity. So it's just really about refilling that supply chain as fast as possible. Where we do better, actually, is in fresh. I was in stores yesterday after the call with the president, and we stood very tall in produce and deli and seafood, where we're able to to partner with our local suppliers that can get from farm to fork quicker.
Let me get 3 quick final ones in, if I might. Are you limiting hours in any of your stores, yes or no?
Yes, as of today, we're limiting our store hours. So all of our stores, Tyler, are going to close at 9 p.m.
And what about quantities? Are you limiting the number of items that people can walk out with so that they don't go out with 42 rolls of toilet paper?
Yeah, absolutely. In some categories, we've actually limited. And we're just asking customers to be kind to each other and to be respectful.
And finally, you have 137 Winn-Dixie beer, wine, and spirit stores. Are sales up?
Yes, they are. People during disaster like to relieve themselves with wines and spirits, Tyler, that's for sure.
Anthony, thank you very much. Anthony Hucker of Southeastern Grocers. Keep up the good work. Kelly.
Yeah, seafood and wine got the message. It's not just restaurants, bars, and gyms that are closing to try to halt the spread of coronavirus. Retailers are also shuttering. That includes Apple stores, and one Apple employee in the U.S. has tested positive for coronavirus. Josh Lipton has more for us. Josh?
So, Kelly, we have a statement here from Apple on that. Let me read that to you, saying a team member in the Culver City office has informed the company that they did test positive for coronavirus. The individual had no symptoms, Apple saying, when they were last in the office and remains in self-isolation at home. Of course, Kelly, that news coming as really Apple surprised investors, making this dramatic announcement that they would shut all retail stores, close all retail stores outside of Greater China until March 27th. It's a good reminder of just how big Apple's retail footprint really is. That company now has 510 stores all over the world, 271 here in the United States alone, and 52 stores in that Greater China region that will in fact stay open. Remember, that's an operating segment that includes China, Hong Kong, and Taiwan. So why make that decision? Well, Tim Cook wrote a letter over the weekend, posted on the company's website, saying that the most effective way to minimize the risk of the virus's transmission, he writes, is to reduce density and maximize social distance. As for what this means for investors, Loop Ventures estimates that if the stores really do remain closed only until March 27th, as expected, then this decision, they think, impacts revenue in the current quarter by about 2%. Of course, key questions for investors looking forward: what happens if those stores remain closed beyond that March 27th deadline? And then also, how does that economic slowdown weigh on consumer spending, and what in turn that means looking ahead for iPhone demand? Guys, back to you.
Josh, thank you very much. We've got breaking news on our parent company, Comcast, and Julia Borston has the details on the phone. Hi, Julia.
Hi, Tyler. That's right. NBC Universal, CNBC's parent company, just now announcing that Universal Pictures will make its movies available at home on the same day as their theatrical releases. The upcoming Trolls World Tour movie will be the first movie that will be available in what's called a day and date release, meaning that you can rent it at home the same day that it's made available in theaters. That Trolls movie is opening April 10th in the U.S., so they'll make it available at home then. Now, the company also announcing that they'll make movies that are currently in theatrical release available on demand streaming starting Friday, March 20th. That includes The Hunt and The Invisible Man and Emma. All three of those are all currently in theaters. Now, they are going to be available for a 48-hour period for rental. The suggested retail price is $20 in the U.S., an equivalent in international markets. This is a big move by Jeff Shell, newly appointed CEO of NBC Universal, to try to close that window between when films are available in theaters and when they're available at home. And of course, this comes as movie theaters have been closed around the world. We're starting to see closures here in the U.S., and companies like AMC announce that they're going to be doing social distancing within their theaters and effectively limiting capacity in the theaters that are open by 50%. So this is a big move by Universal to try to make their films available with a whole new model during this coronavirus situation.
Mike, Julia, does this mean that I can get it on demand no matter what cable or satellite system I'm on? In other words, I do not have to be a Comcast customer to take advantage of this.
Correct. So this would be just a regular rental service. So now you can go on, so I rent movies, say, from iTunes, or you can rent them from Amazon Prime, and you can find movies, and depending on how recently the movies have been in theaters now you can go rent or even purchase for download a movie. And the cost usually varies depending on how recent the movie has been in theaters. This is the first time we've seen a major studio offer a film for rental at home for basically access for 48 hours, the same day that it would be available in theaters.
Julia, thank you very much. Kelly?
All right, Tyler, thanks. The financials dropping 10% today, and it's been the regional banks that have really taken it on the chin. Why? Well, the 10-year Treasury yield is dropping to near historic lows. The regional bank ETF is down 30% this month alone. With us now on the CNBC Newsline is Ira Robbins. He is the CEO and president of Valley National Bank. Ira, it's good to see you. And first of all, is business suffering?
Business is definitely down as a result of this. However, for us, we've done $1 billion in loan originations just this year so far. To really put that into perspective, that's about 20% greater than where we were the same time last year.
Wow.
So although activity's down a bit over the last couple of weeks, going into the quarter, we were looking pretty strong.
So you take that 20% increase in loan originations as a sign of the better economy going into coronavirus, or is it desperation from customers now?
I think it's the better economy going into it. We're also looking at absolute low levels of interest rates that many of our customers haven't seen in a very long time. When we look specifically at residential mortgage as an example, we're up 75% in activity for the first 2 weeks of March versus where we were on average for the month of February.
Wow.
And most of this is largely just refinance activity and not necessarily new overall purchases. So the actions that the Fed's been undertaking with regard to monetary policy is actually stimulating certain segments of the industry.
Do you have the capacity to handle all of the refi and maybe new origination demand for mortgages, especially if your staff is now starting to work from home or be impacted by coronavirus?
I think it's a great question. I think right now we're able to. The benefit with having refinances as opposed to residential mortgages is there's some flexibility as to when the closings on those are. So right now we don't see any hiccups, businesses as usual within that specific market. But you look at other areas that we service. We do a very large auto business. We have about 1,000 auto dealers across the eastern seaboard. Their volume's down about 50% when we over week. And you're seeing shifts significantly from new cars to used cars. And I think that's where many of our consumers are looking at delaying new car purchases as they're not quite needed. But for some of our used car consumers, they're really looking at it and saying a new car is maybe a better alternative than getting into an Uber.
Wow. Ira, you're my new favorite guest maybe, but for all the wrong reasons, meaning, I do appreciate your candid picture of what's happening out there with the economy. I just wish the news weren't so bad. So just make sure everyone heard what you said. Your auto dealers, you have about 1,000 of them, are down 50% in business as people are also shifting from new to used cars. So let me ask you this, whether it's those customers or others, what happens to the businesses who are or will soon be in a cash flow crunch situation? We spoke to Washington Federal Bank out of Seattle the other day. They said they're trying to extend $100 million of emergency loans to help people get through this period. Can you guys do something like this as a regular course of business? Can people draw down lines of credit and so forth? I mean, how do you kind of help your customers stay viable throughout this?
Once again, it's a great question. That's what banks do. And I'm not alone, I don't think, in answering this. But our function is to make sure we're there for our customers in times like this, not necessarily just in the good times. So when Hurricane Sandy hit previously, when the financial crisis hit in 2008, we were out there providing loans to many of our constituents, whether it be deferrals when it comes to certain payments, whether it be interest only. But banks are more focused on structuring a loan that makes sense for a customer as opposed to going through a foreclosure process for many of the customers. I think when we look at what's happened in the industry, we've seen such focus on technology and such focus on fintech. I think this is an opportunity for regional banks similar to myself to really look at this as an opportunity to once again provide that a people-human relationship is more valuable than what necessarily a technology relationship is.
So you think you can keep your customers from going out of business, basically, in a quick word?
Absolutely, no question.
Wow. Ira, thank you so much. We really appreciate it today.
Thank you so much for the time.
Ira Robbins of Valley National Bank.
Well, Kelly, we've got breaking news out of Washington, D.C., and Eamon Javers has the details. Hi, Eamon.
Yeah, hi, Tyler. The details are Senator Chuck Schumer on Capitol Hill is now proposing a third COVID response bill. This one, he says, would be up to $750 billion in federal assistance. Now, this would become after the current bill, which was passed by the House last week and is now held up a little bit on Capitol Hill as they try to work out some technical corrections and some potential objections from Republicans up on Capitol Hill. What Schumer is talking about as a Democrat in the minority in the Senate is $750 billion that would do a number of things, including address hospital and treatment capacity issues, expand unemployment insurance, provide immediate loan payment forbearance for all federal loans and moratoriums on evictions and foreclosures, deliver immediate help to small businesses, fund emergency child care, especially for healthcare workers and first responders, help schools with remote learning, ensure senior citizen medicine and food delivery, and provide assistance to keep public transportation running, among other items. So that, bear in mind, would be a third bill that would have to be worked out between Republicans and Democrats in the Senate and then also in the House of Representatives. But you get a sense here, guys, that what we're going to see is wave after wave of congressional action responding to the evolving needs here of the COVID situation. Back over to you.
Eamon, thank you very much, Eamon Javers. Now, casinos are also getting crushed again today as they start to shut down locations in the U.S. Wynn, MGM, and Las Vegas Sands all dropping nearly 20%. Contessa Brewer is digging more into these moves for us. Contessa.
Hey there, Kelly. Michigan, Massachusetts, Maryland, New Mexico, Indiana, Ohio, Illinois, Louisiana. Those casino shutdowns just go on and on. Wynn Resorts has drawn down its credit line reportedly, closed its Las Vegas casinos. MGM has suspended its strip operations too, canceled its $1.25 billion share buyback, and announced furloughs and layoffs. I'm told Caesars is sending out similar notes to employees. Now, there are big questions swirling about Caesars' pending merger with Eldorado. Though funding commitments were in place, it is down. Eldorado, for instance, 72% over 3 months. Carl Icahn went on with Scott Wapner and kind of poo-pooed the idea that this merger could be in danger. Penn National Gaming with nearly 50 properties, but fewer than 5 months of liquidity, according to Deutsche Bank estimates. And its stock is seeing an incredible plummet from what was an immense run-up over that partnership with Barstool Sports. But now, of course, there's no sports to bet on. And then the gaming REITs that own the land under Penn Properties, Gaming and Leisure and Vici, they're also down on fears that what will happen is the casinos won't be able to pay their rent. Deutsche Bank, though, gave MGM Growth Properties, MGP, an upgrade with a $35 price target. And Las Vegas Sands itself got an upgrade to buy from Jefferies today because of its strong balance sheet and its steady leadership. That balance sheet is something that I'm seeing come up over and over again, really important right now amid the crisis, Kelly.
Yeah, can separate the strong from the weaker. But Contessa, are these actual casinos shut down right now? Why isn't all of Las Vegas shut down?
It's a great question. The governor has said he wants to respect those who voluntarily shut down. Remember, Wynn and MGM had experience in Macau, so they know what it means to shut it down and to try and keep coronavirus from spreading. Other casinos have chosen to stay open right now. They're monitoring the situation. Caesars told me about social distancing. They're actually going in and turning off certain screens of their slot machines so that people have to sit farther away from each other in order to play, but they still have people coming in.
Contessa, we appreciate it. Contessa Brewer with the moves in these casino stocks today, I should say.
Yeah.
Ty?
All right, thank you very much. The volatility index spiking again today, now at its highest level since the financial crisis. Joining me now to discuss the ongoing volatility is Tal Cohen. He's head of North American Market Services at the NASDAQ. Tal, how are you handling all of this?
Well, the last week and a half has certainly been unprecedented and historic in many ways. And I'd say the market overall, and NASDAQ in particular, has handled it very well in terms of market resiliency and availability of our markets. Our markets are functioning. We're able to handle the elevated volumes. Of course, we hit market-wide circuit breakers twice last week and once again today, and that's not been tested before. So these new market guardrails have worked for the first time. We entered into a halt on an orderly basis. We came into the reopening on an orderly basis. The industry responded well. And from a NASDAQ perspective, most importantly, we wanted to get our stocks up and running, quoting and trading immediately so that we could support a robust price discovery process. And the feedback we've gotten so far from the industry and the SEC has been generally positive.
I see my notes tell me that you're closing options trading in Philly tomorrow. Why?
So what we're closing tomorrow is the open outcry floor of the Philadelphia Stock Exchange. So to be clear, Philadelphia Stock Exchange and Philadelphia Options Exchange will be open for business on a fully electronic basis.
I see.
And after careful consideration and collaboration with the floor traders, we made the decision to put people's well-being and safety first. So we have suspended floor operations for the time being.
Yes, my note said trading floor in Philly. I should have noticed that, but I just misread it. Let's talk a little bit about the flow of IPOs. I know that is one of the lifebloods of your business. I can't imagine there's much blood circulating in that realm right now.
There are still pockets of activity in the IPO pipeline. So we see biotech, health, and SPACs still somewhat active. And if I took a step back and looked at S1 filings, the pipeline still looks robust to us compared to 2019. Now, of course, based on market volatility and valuation being suppressed, they'll probably push out those dates. And from what we can tell, they're still preparing. We're still engaged with them. And so we hope that they come out later this year, and we'll be ready to welcome them.
You know, there has been some talk in some quarters that markets ought to take a breather, shut down for a little bit. I assume you don't agree with that.
We understand the sentiment in that it's unprecedented in terms of the events that we're seeing and the volatility we're seeing and the heightened levels of activity. But markets are functioning well. And so the question we would have is, what is the rationale for that? Will that improve investor confidence or not? Are we setting the precedent that we want to set or not? And from our perspective, if there needs to be a conversation, let's make sure that it's coordinated with the SEC, with other exchanges. Let's talk about how the market-wide circuit breakers have been working or not working. But in that context, let's make sure that we're solving for problems that we see in the marketplace, because our concern is that just by shutting down the marketplace, it's hard for us to understand what problem we're solving.
And the market seems to be, from where you're sitting, functioning just fine. It's not overwhelmed. There is volatility, but there's price discovery, there's liquidity, and so forth. Right, Tal?
There's a high level of resiliency and availability and certainty in our systems and across the markets.
All right, Tal Cohen, thank you very much. We appreciate your time. Tal is the EVP at NASDAQ in charge of market services. Kelly, what another day it has been.
Yeah, for you way over there, Ty.
Can we get a shot of social distancing in real time here? Is there a way to show where I'm sitting and where Kelly's sitting?
We are all the way.
We're a good long way. They'll work that out.
We're sitting way apart from each other.
I miss you over here.
There
you are. Get that jib to come swing on over. There I am.
See you way over there?
Hello. Yeah. How are you?
This is what we do to keep everybody safe. On that note, Ty, we're talking about how to keep the market safe. A couple different ideas here. Terry Duffy said maybe we should narrow what counts as kind of stopping trading, maybe down 10%, maybe not let it go down 20%. Neil Bradley, the Chamber of Commerce, said he wants that payroll tax cut. It could help small businesses immediately, emergency lending, more Fed facilities. I think we're going to hear, calls for more help on commercial paper. There's a lot of demands on the table today.
No, there really is. And it was very interesting to hear the guest from Valley National Bank, as well as the WaFed guy on Friday, talking about extending loans so that small businesses don't go out of business under the stresses that they have in terms of their cash flow.
Yeah, everyone go back, listen to Valley National. Fascinating, candid discussion with the CEO. His clients are down, but he said it's good business for them to keep them going if they can. But now we'll turn it over to Closing Bell. Thanks for watching Power Lunch.
And we got more breaking news and market coverage. The final hour is here.
Kelly and Tyler, thank you very much for that 1 hour until the close. I'm Wilfred Frost of the New York Stock Exchange. We're doing our part here on Closing Bell as well to social distance while staying focused on bringing you the most important market moving news of the day. I'll be with you this hour. Sarah Eisen will join you after the close at 4 p.m. Stocks are back in free fall. The Dow down around about 9% right now. We are awaiting a briefing as well from the White House in the next 30 minutes time. In the meantime, let's have a look at what is driving the action. First and foremost, of course, the heightened fear about the coronavirus as more countries go into lockdown as the steady spread of cases continues. The Fed made a dramatic move, cutting rates to zero and announcing new asset purchases in an emergency weekend announcement that is failing to reassure investors today. And on the data front, we're starting to see some early signs of the virus's economic slowdown with weak manufacturing data this morning from both China and the US. As we just said, we are down about 9% on the Dow. The low of the session was down 12% or 2,800 points. The Dow is down about 31% from its recent market highs as we stand with just under an hour's left of trade. We've got every angle of this covered for you. Let's drill down on the sell-off with our team of reporters. Bob Pisani's here on the floor of the stock exchange. Mike Santoli has his market dashboard. Steve Leisman has details on the Fed's massive moves. But let's begin with Bob here on the floor of the exchange.
Very interesting morning. Again, a trading halt this morning, 15 minutes right after the market opened. Our third trading halt in the last 6 trading sessions. Take a look at the S&P 500. Our low is just a tad above 2,400, so we're well off of that number. Waiting, everybody down here at least waiting to see what, if anything, the president might have to say. Take a look at some Dow movers. Again, this bifurcation in the market we talked about, this started emerging on Thursday. Again, notable today, if you take a look at some of the big names like Boeing, JP Morgan Chase, economically sensitive, the cyclical names, all down in the double-digit areas. If you look at some of the more consumer-oriented names, for example, such as Coke or Procter & Gamble, those names generally holding up much better overall. Elsewhere, there are certain market gainers that we've seen, largely consumer names as well here. So Rite Aid says that it's working with the White House task force to offer testing in their parking lots. That stock's up. Kroger's been doing great recently overall. Clorox got an upgrade from JP Morgan. Campbell's Soup, also one of those consumer names that's been holding up much better than the overall markets here. Buy recommendations. Some people are actually making some bold calls. I mentioned Clorox getting an upgrade, but Caterpillar also got an upgrade today to buy from Stifel, saying it's an attractive entry point. Hard to believe, but some people still really are trying to buy into the markets. And there you see Caterpillar holding up much better than its industrial brethren. Guys, back to you.
Pisani, thanks so much for that. I should mention the White House briefing expected to start earlier now, about 3:15 p.m. We will, of course, bring you that live when it begins. Meantime, let's get over to Mike Santoli, who is taking a look at various key market levels. Mike.
Yeah, Will, thanks very much. You know, with these huge moves every day, it's very hard to kind of remember where we stand in the short and long term. Bob mentioned S&P holding above the morning lows. It's also refused to go below for any length of time Thursday's lows. We'll see if that matters at all. We've basically gone back in the vicinity of that December 2018 low. That was 2351. We only spent one day below 2400. That was this morning's low. So we're pretty close to that mark of where some people have said this was headed all along. Also, I want to point out, if you go back to when we first got to around these levels in the mid-2450s, mid-2400s, it was basically 2.5 years ago. So you're talking about early 2017. Typical bear market associated with a recession throughout time has gotten rid of about 3 years worth of bull market. So, you know, we're not too far off of that. I also want to take a look at subsegments of the market. If you thought at the peak in February that the problem with the market was too much market value is captured by the big NASDAQ stocks, they were overvalued, everything else looked relatively good, hasn't helped you. Obviously, it's been basically everything down a similar amount except small cap stocks down more, the Dow down more. So you really have not necessarily paid during this downturn to say, hey, what didn't really participate in the upside? Let me see. No, it's gotten hit worse. So clearly it's been a very comprehensive sell-off. We're going to see if today in intensity how it compares to last Thursday, because we're looking for some signs, tentative or not, that in fact we've gotten somewhere near some peak panic, guys.
Mike, interesting, of course, there to see the Russell's the worst performer given its heavy weighting to banks and energy companies, both of which have been the worst throughout this sell-off. And again, the worst today, both down about 10%. If the team can bring up the S&P 500 intraday chart again behind you, Mike, have we seen any evidence throughout this incredibly volatile day of buying the dips at all?
A little bit, you know. I mean, we've basically seen the low was made pretty much right near the open. We had that trading halt. After the halt, there was a lot of drift, and there has been some signs that the market was sort of gravitating back toward 2,500 level. Again, I've been saying for 3 weeks, there's a real hazard in trying to extrapolate the intraday activity to the next day because, by the way, most of the violent action has been happening overnight in the futures, massive gaps on the open. So it hasn't as much been the intraday swings, at least not principally in terms of on the way down.
Okay, Mike, thanks so much for that. Now, the Fed took extraordinary measures last night, cutting rates by 100 basis points to zero and launching a massive $700 billion quantitative easing program. Steve Leisman joins us with more on this historic move. Steve.
Yeah, Wolf, the day after that historic move that included bringing rates down to by 100 basis points to 0 to 25 basis points and injecting launching $700 billion of purchases. The reviews are not very good. Talking to people in the fixed income markets, I'm hearing that some markets, maybe even most markets, U.S. funding markets, are still not functioning smoothly to the extent that the Fed had to come in the afternoon and do a second $500 billion overnight repo, which is to say the Fed put on offer $1 trillion worth of repo today. Has not done an afternoon one as far as I can tell. Just did a morning one, and 129 billion was taken down. The Fed has been out there doing the first purchases of the 700 billion. It did $40 billion today, and there were very large submissions for these offers by the Fed for the treasuries. And then the market is simply looking for the Fed to do more. Guys, one thing that's changed and changed markedly is the economic outlook. There was a lot of belief in a V-shaped recovery. Not so much the case anymore. If you look at our Fed survey that we did over the weekend, 67%, there's now a 67% probability in the next 12 months of a recession, the highest we've had in that survey, up from 41%. And then very quickly, if you look at it quarter by quarter, looking at a 1.1% first quarter, followed by a negative second quarter, flat third quarter, and then a rebound in the fourth quarter. If that is the odds-on bet now of our 40 respondents to our Fed survey. And you know, guys, this was very different even, I want to say, a week or two ago when it was thought maybe you had some decline in the second quarter, but a quick bounce back in the third. That's now been pushed back into the distance, and it's part of what's troubling stocks and what's troubling fixed income markets.
Steve, I'm afraid to say it's just guys, singular, not guys, plural, because of social distancing. I just want to add to a little bit of what you said there. As I mentioned to you over email, I spoke to one of the CFOs of the nation's top 4 biggest banks about that freeze-up or apparent freeze-up of the repo market, and they did suggest that it opened pretty badly earlier today, but that the Fed got that back under control by bringing forward that extra tranche of $500 billion on the repo side, and that the thing the market's focused on now is commercial paper as opposed to treasuries, and that is struggling to find any clear pricing, and that it may then therefore mean that the Fed has to move to start to buy commercial paper as well. And Steve, as I understand that would require Treasury approval, but not congressional approval. Either way, my question to you, Steve, is at what point do we get to the market looking at this to say the Fed has, over the course of 2 weeks, really deployed almost all the tools we thought it had at its disposal, and yet there are still more problems that start to arise at each level?
Yeah, there's a lot for the Fed to do here. There's a lot more debt, Wilf, than there was back in the 2008 crisis. In fact, the amount of Treasury debt is triple what it was back then. And dealer balance sheets, as you know, are not triple the size. In fact, they may be somewhat smaller in terms of total capacity out there among the dealers. I expect, Wilf, and I'm going out on a limb here, in the next day, maximum 2, the Treasury and the Fed to come in with a commercial paper program and maybe some additional facilities to take collateral off of the balance sheet of the dealers out there. I don't think the Fed is done. I think actually the only reason, I don't have any inside information on this, just to be clear, I'm just thinking about what I know about the Fed. The only reason they didn't do these additional programs was because of the capacity they had to do all of these things. What they did on Sunday, Wilf, was what they did over several weeks and months during the financial crisis. This was a major series of programs they rolled out Sunday. I think the next couple of days you may get more from the Fed here.
Steve Leisman, as ever, thank you so much for that. Now, also last night, 9 of the nation's biggest banks, and perhaps counting, we'll see more, took the unprecedented step to suspend buybacks together for at least Q1 and Q2. The original announcement came somewhat surprisingly via the Financial Services Forum. The main reason for this is that the banks want to make clear they aim to be part of the solution this time, not the problem. Continuing buybacks risk painting the wrong image, therefore. They all maintain they did not need to take this action, that they have plenty of liquidity, and indeed the Fed's actions in the last few weeks have made that more certain, the discount window decision in particular. This did not stem from the White House meeting with bank CEOs last week, but rather the last 48 hours as it became clear to the banks that the Fed was going to act in a large way last night. This was the bank's show of good faith, if you will, to the Fed, rather than the Fed necessarily demanding it of the banks. Now, bearish bank investors have said to me today that why this collective approach, why via the Financial Services Forum, and they asked whether there was a weak member of the herd that maybe needed to be protected. But the messaging from all the banks, and indeed the signs of liquidity injections, suggests absolutely the opposite. Regardless, bank shares sinking sharply yet again today. Goldman Sachs, by the way, estimates that if maintained for all of 2020, this move would remove $80 billion worth of buying from the market for bank stocks. The collective market cap for the banks in question was $960 billion. Clearly well below that now based on today's moves. That number was before the open. The banks index down about 13.5%. I should mention Wells Fargo, which is down about 47% from its peak, is down enough that the CEO, Charlie Scharf, stepped in to buy about $5 million worth of stock today. Mike, of course, is still with us on the banks. And Mike, the other factor that's hurting these stocks today is a move in yields, albeit the yields are some way off the lows of the last couple of weeks, whereas the KBW Banks Index was below its recent lows earlier in the session, down about 47% from its peak in January.
Sure. I mean, longer-term yields, absolutely, although Fed going essentially back to zero is obviously a headwind and presumably going to stay there for a while. Plus, at the same time, of course, the conversation has turned toward, what is the erosion of credit quality and, across the economy and across these loan books, even though it's nothing critical. And, of course, the $80 billion that's not going to be spent now on buybacks is going to stay as a partially as a cushion on the bank balance sheet. So that's a net positive if you're talking about where the risks are. But in terms of the drivers of the stock prices, a few of those things that have been removed that people have been pining for, right, which are the buybacks and also the credit situation, which for years was something we didn't have to worry about. Now, it's not acute right now, but it's definitely not moving in the right direction. So the question being, the stock price has already accounted for all of those difficulties, and one can make the argument at this point.
Yeah, Mike, the other thing I'd point out, of course, yes, removing those buybacks, as we've already discussed, removes a potential buyer for the stocks. They've all maintained their dividends, though. Wells Fargo, according to FactSet numbers, 7% yield now. Citigroup close to 5%. All of them at least above 3%, most of them above 4%. So that's, of course, a support of sorts. The only other thing I point to, Mike, broadening it out a little bit, of course, some sectors here in the U.S., like energy, like banks, are well below levels of the last couple of years. S&P 500, though, of course, still isn't. It is down sharply, 27% or so from its recent highs. Just want to mention some of those European markets because they are down a lot more from the recent highs. FTSE 100, 35% down. Stock 600 Europe down 34% from its recent highs. And again, that just highlights the sort of potential to fall further here in the U.S. if you're comparing to the situation over there.
Well, especially if the weakness really comes for the big growth stocks and the more defensive areas of the market, which tend to be a slightly larger portion of our index here. So the reason that we can sort of withstand these declines in banks and in energy stocks and some other cyclicals is that you have those incredibly large growth stocks that have more or less held things up for a while. So, yeah, that is the kind of two sides of that coin, either been more resilient or more room left to fall if, in fact, the bear market comes for everything.
Okay, Mike, thanks so much for that. We're down 9.5% on the Dow, 45 minutes left of this crazy session. Tonight, by the way, don't miss a CNBC special report, Markets in Turmoil, 7 p.m. Eastern Time. Breaking news out of San Francisco. Deirdre Bosa has a story for us. Hi, Dee.
Hey, well, San Francisco Mayor London Breed tweeting moments ago that effective at midnight, San Francisco will require people to stay home except for essential needs. She says that necessary government functions and essential stores will remain open. And, well, this is called a shelter-in-place directive. And according to other local reports, surrounding counties making up the Bay Area will also be placed on this lockdown until April 7th. And this shelter-in-place directive falls just short of a full lockdown, which would forbid people to leave their homes without permission. It's unclear as of now how this would be enforced. We have calls out to the San Francisco mayor's office and surrounding counties for more information. Well, if there will be a full briefing at 1 p.m. local, that's 4 p.m. Eastern, less than an hour away. Back to you.
Dee, thanks so much for that. Let's turn to Washington now and the latest discussions from lawmakers to battle the economic fallout. Eamon Javers has more for us. Eamon.
Yeah, Wilfred, we're waiting for this White House briefing, which is scheduled now to start at 3:15 p.m., so keep an eye out for that. Meanwhile, Chuck Schumer, the Democratic leader in the Senate, now has a new proposal out for a $750 billion spending bill that would help a whole range of American institutions prepare for and deal with the coronavirus crisis. And just looking at this list, Wilfred, it does give you a sense of just how dramatic the impact of this is going to be. They're talking about helping hospitals, helping the unemployed, loan payment forbearance for all federal loans, and moratoriums on evictions and foreclosures, using the Defense Department to provide personnel, equipment, supplies, and response capabilities to support the nationwide response, ensure senior citizen medicine and food delivery, help schools with remote learning, a whole range of concerns that Congress has to deal with in the coming days and weeks. Meanwhile, Larry Kudlow was out in the White House driveway earlier today and was talking about what assistance the airline sector might need. Here's what he said. Oh, and I guess we don't have that soundbite, but Larry Kudlow said earlier today that the airlines may need some cash, may need some liquidity. He said the White House has been in consultation with them. We'll see where that effort goes as well. But you can imagine, Wilfred, that the airlines are sort of at the tip of the spear here in terms of impact, but that impact is going to hit industry group after industry group after industry group throughout the economy, Wilfred.
Certainly are, Eamon, and I know the investors would love to see some kind of support, debt support for those types of companies, but a long way to go to get that sort of congressional approval. Eamon, thank you for that, and you saw a live picture alongside Eamon there of the White House briefing room. We are expecting that White House briefing from the coronavirus task force to start any minute. We'll bring it to you live, and no doubt there'll be some market-moving information in that. The markets, by the way, down 9.2% on the Dow, 8.5% on the S&P 500 with 43 minutes left of the session. Joining me now by phone, Kathleen Sebelius, former Health and Human Services Secretary under President Obama. She was HHS Secretary during the H1N1 pandemic, 2009 and 2010. Thank you so much for joining us this afternoon.
Sure.
Can I start by asking you what you really want to hear today from this White House briefing that we haven't heard yet? There have been a lot of significant announcements in the last 3 days. Do you feel like the White House is now on top of things?
Well, I think they're certainly moving in the right direction. The declaration of a national emergency does open some flexibility for particularly governors and mayors, and they're taking full advantage of that. We have to get some money flowing quickly, so the Senate needs to act right away on the House passed bill as step one and hopefully get that money flowing, because lots of people are now closing their restaurants, closing their shops, losing money as we speak. And the faster we can get some relief to particularly small business owners, employees who work on an hourly wage, so they can pay for extra child care, so they can buy groceries, so they can pay their rent. Those are really urgent needs. And I haven't heard the White House talk about that a lot. And the third thing, I think it's important that testing seems like it may be ramping up, but I think they've got to be honest pretty quickly with the American public about, even as those tests ramp up, who are the likely priorities, who is going to get. I assume we're going to look at people who have serious medical conditions as the first rung. Secondly, we got to get healthcare providers tested, because the worst of all worlds is to have healthcare providers in and out of healthcare settings carrying the virus. And then we need to do broad-based testing so we can establish some patterns. We don't really know if kids are carriers. We know they seem to be not getting the disease, but are they carrying the disease? What about young adults? How wide is the group of carriers who are asymptomatic? Once we know that, then you can begin to make decisions about who actually should stay on lockdown, who should be distancing. Can you reopen some schools or areas for kids? We don't know any of that until we get the testing much more broadly distributed.
And Secretary Sebelius, let's focus a little bit more on that side of things, the health and medical side of things. This morning on Squawk Box, Dr. Scott Gottlieb, the former FDA commissioner, said that he felt things should peak on the medical side by April or May. Do you concur?
Well, I hope he's right. I don't think we really know how broad this virus is in the United States. I mean, we know that every state, I think, with the exception of one, now has cases. But how many cases are out there wandering around without specific identification, we really don't know. And until, I guess, we know that, hopefully, Scott is correct. Whether it peaks and dies down like a flu cycle and then comes back in the fall is also something we can watch the Southern Hemisphere and figure out kind of what's going on a little bit more. But that's another wave that I think we've got to get ready for, because we're not likely to have a vaccine by the time the weather gets cooler again.
Do you have any sympathy? Oh, 1 second, Secretary Sebelius. Let's go to the White House task force. It's starting now.
So I'm glad to see that you're practicing social distancing. That looks very nice. That's very good. I want to thank everybody for being here today. This morning I spoke with the leaders of the G7 nations, and they really had a good meeting. I think it was a very, very productive meeting. I also spoke with our nation's governors. And this afternoon we're announcing new guidelines for every American to follow over the next 15 days as we combat the virus. Each and every one of us has a critical role to play in stopping the spread and transmission of the virus. We did this today. This was done by a lot of very talented people, some of whom are standing with me, and that's available. And Dr. Birx will be speaking about that in just a few minutes. It's important for the young and healthy people to understand that while they may experience milder symptoms, they can easily spread this virus, and they will spread it indeed, putting countless others in harm's way. We especially worry about our senior citizens. The White House Task Force meets every day and continually updates guidelines based on the fast evolving situation that this has become all over the world. It's all over the world. It's incredible what's happened in such a short period of time. On the guidelines of the task force, the new modeling conducted by Dr. Birx, and our consultation with governors, we've made the decision to further toughen the guidelines and blunt the infection now. We'd much rather be ahead of the curve than behind it, and that's what we are. Therefore, my administration is recommending that all Americans, including the young and healthy, work to engage in schooling from home when possible, avoid gathering in groups of more than 10 people, avoid discretionary travel, and avoid eating and drinking at bars, restaurants, and public food courts. If everyone makes this change or these critical changes and sacrifices now, we will rally together as one nation, and we will defeat the virus, and we're going to have a big celebration all together. With several weeks of focused action, we can turn the corner and turn it quickly. A lot of progress has been made. I'm also pleased to report today that a vaccine candidate has begun the phase 1 clinical trial. This is one of the fastest vaccine development launches in history, not even close. We're also racing to develop antiviral therapies and other treatments, and we've had some promising results, early results, but promising, to reduce the severity and the duration of the symptoms. And I have to say that our government is prepared to do whatever it takes. Whatever it takes, we're doing. We're doing it in every way. And with that, I'd like to just introduce Dr. Birx, who's going to discuss some of the things that we strongly recommend. Thank you.
Thank you, Mr. President. I think you know over the last months, we've taken very bold action to stop the virus from coming to our shores. And because of that, we gained time to really get together and understand the progress across the globe of what has worked and what hasn't worked. We now need to appeal to every single American so that they can have their role in stopping the spread of this virus. We've talked about things before about washing your hands, but we really want to focus on if you are sick, no matter who you are, please stay home. If someone in your household is diagnosed with this virus, the entire household should quarantine in the house to prevent spread of the virus to others. The reason we're taking these strong and bold steps is because we know there is virus spread before you develop symptoms, and then we know that there's a large group, we don't know the precise percent yet, that actually is asymptomatic or has such mild cases that they continue to spread the virus. If your children are sick, please keep them home. Now to our older population or those with pre-existing medical conditions, everyone in the household needs to focus on protecting them. Everyone in the household. I want to speak particularly to our largest generation now, our millennials. I have the mom of two wonderful millennial young women who are bright and hardworking, and I will tell you what I told to them. They are the core group that will stop this virus. They are the group that communicates successfully, independent of picking up a phone. They intuitively know how to contact each other without being in large social gatherings. We're asking all of them to hold their gatherings to under 10 people, not just in bars and restaurants, but in homes. We really want people to be separated at this time. To be able to address this virus comprehensively that we cannot see, for which we don't have a vaccine or a therapeutic. The only thing we have right now is the amazing ingenuity and compassion of the American people. We're appealing to all Americans to take these steps, to protect each other, and to ensure that the virus doesn't spread. These guidelines are very specific, they're very detailed. They will only work if every American takes this together to heart and responds as one nation and one people to stop the spread of this virus. Thank you.
Thank you very much, Dr. Birx. So just to connect with what I mentioned to you in previous discussions in this room, and Dr. Birx said it very well, that in order to be able to contain and curtail this epidemic to not reach its maximum capability, we have a two-pillar approach, one of which I believe has been very effective in preventing the substantial seeding, and namely the travel restrictions that we've discussed many times in this room. The other, equally, if not more important, is when you have infection in your own country, which we do. And, you know, I could read the numbers, but they're really essentially what we've seen yesterday, incremental increases both globally as well as in the United States with the curve doing that. So therefore, the kinds of things that we do are containment and mitigation. What we're mentioning now, the guidelines, when you look at them carefully, I believe if the people in the United States take them seriously, because they were based on some rather serious consideration back and forth. Some may look at them and say they're going to be really inconvenient for people. Some will look and say, well, maybe we've gone a little bit too far. They were well thought out. And the thing that I want to reemphasize, and I'll say it over and over again, when you're dealing with an emerging infectious diseases outbreak, you are always behind where you think you are if you think that today reflects where you really are. That's not word speak. It means if you think you're here, you're really here because you're only getting the results. Therefore, it will always seem that the best way to address it would to be doing something that looks like it might be an overreaction. It isn't an overreaction. It's a reaction that we feel is commensurate, which is actually going on in reality. So take a look at the guidelines, read them carefully, and we hope that the people of the United States will take them very seriously because they will fail if people don't adhere to them. We have to have, as a whole country, cooperate and collaborate to make sure these get done. Thank you.
Okay, go ahead.
Mr. President, a lot of people are concerned about how long all of this might last. Do you have any kind of estimate that if Americans really were to band together and do what the White House is suggesting, how quickly you could turn this corner?
My favorite question, I ask it all the time. How many times, Anthony? I think I ask him that question every day, and I speak to Deborah, I speak to a lot of them. I get the opinion. So it seems to me that if we do a really good job, we'll not only hold the death down to a level that is much lower than the other way, had we not done a good job. But people are talking about July, August, something like that. So it could be right in that period of time where it washes through. Other people don't like that term, but where it washes through.
So is this the new normal until the height of the summer?
We'll see what happens, but they think August, could be July, could be longer than that. But I've asked that question many, many times. Yes.
That being said, Mr. President, Americans today and looking forward are living with so much anxiety and so much fear facing uncertainty right now. I'm curious, how are you talking to your own family about this? How are you talking to your youngest son? Do you empathize with this sense of anxiety? People are really scared.
Yeah. No, I think they are very scared. I think they see that we're doing a very professional job. We've been working with the governors and frankly, the mayors, local government at every level. We have FEMA totally involved. FEMA's been, usually we see FEMA for the hurricanes and the tornadoes. Now we have FEMA involved in this. They've been doing a fantastic job locally, working with people that they know because they work, like as an example, in California, in the state of Washington. They work with them a lot on other things, and they're very familiar, so they're working on it. What you can do, and all you can do, is professional, totally competent. We have the best people in the world. We have really the greatest experts in the world. And someday soon, hopefully it'll end and we'll be back to where it was. But this came up, it came up so suddenly. Look, you were surprised. We were all surprised. We heard about it. We heard about reports from China that something was happening, and all of a sudden, we did make a good decision. We closed our borders to China very quickly, very rapidly. That was a otherwise, we'd be in a very, as Tony has said numerous times, we'd be in a very bad position, much worse than we would be right now. You look at what's happening in other countries. Italy's having a very hard time. But I think that what we do, and I've spoken actually with my son. He says, "How bad is this?" It's bad. It's bad. But we're going to be hopefully a best case, not a worst case, and that's what we're working for. Yes.
You can clear up some confusion on two key fronts. One is about your own test. The other is about containment efforts. Is the administration considering more aggressive containment options, like a quarantine, a national curfew, restricting?
Well, we have that very much. Yeah, we have that very much, and we've been pretty aggressive. We were early with Europe, but we were very, very early with China and other places, and fortunately we were. And as far as containment here, we're coming out with strong suggestions. And, it's becoming a little bit automatic. You look at people, they're not doing certain things. For instance, they're obviously not, I wouldn't say the restaurant business is booming, and bars and grills and all. People are self-containing to a large extent. We look forward to the day when we can get back to normal.
To be specific,
what's your second question?
Are you considering instituting a nationwide lockdown, a nationwide quarantine? The NSC knocked that down, but there's still some questions about how it all came
At this point, not nationwide, but there are some places in our nation that are not very affected at all. But we may look at certain areas, certain hotspots, as they call them. We'll be looking at that, but at this moment, no, we're not.
The second question is: you said you had your coronavirus test Friday night. The White House doctor's office put out a statement around midnight Friday saying that no test was indicated. So when exactly was your test administered?
Well, I had my test. I was late Friday night, and the reason I did it was because I had no symptoms whatsoever. So the doctor said, "You have no symptoms, so we don't see any reason." But when I did the press conference on Friday, everybody was going crazy. Did you do the test? Did you do the test? So very late on Friday night, I did the test. And he may have put out, or the doctor may have put out something I don't know what time the letter went out. Maybe it was put out by somebody else. But the results came back, I believe, the following day. And we tested negative.
But the question is, how could the White House doctor's office say a test wasn't indicated, implying that you hadn't had one when in fact you had?
Well, I told them that, and I went totally by what they said, the doctors, more than one. They said you don't have any of the symptoms. They checked what you're supposed to check, and that I didn't have symptoms. But I did a test late on Friday night, and it came back probably 24 hours later or something. They sent it to the labs, came back later. Yeah, please.
Mr. President, you had a teleconference with the nation's governors today. Yeah. And in that teleconference, you told them if they need things like respirators or masks to try to get it on their own. What did you mean by that, and what will the federal government do?
If they can get them faster by getting them on their own, in other words, go through a supply chain that they may have, because the governors, during normal times, the governors buy a lot of things, not necessarily through federal government. if they're able to get ventilators, respirators, if they're able to get certain things without having to go through the longer process of federal government. We have stockpiles now, and we're ordering tremendous numbers of ventilators, respirators, masks, and they're ordered, and they're coming, and we have quite a few at this point. I think, Mike, we have a lot. But if they can get them directly, it's always going to be faster if they can get them directly if they need them. And I've given them authorization to order directly. Go ahead, please.
Mr. President, one of the big weaknesses in our healthcare system is surge capacity for medical facilities, and I wanted to ask what precautions, what planning is being done to get China was able to build hospitals in a matter of days. Are you prepared to use the Corps of Engineers or FEMA to start building surge capacity that we may need in a couple of weeks?
Well, first of all, we hope we don't get there, and that's what we're doing, and that's why we're taking a very strict look at this. But we also are looking at areas, and not only looking, we're expanding certain areas. We're taking over buildings that aren't used. We're doing a lot in that regard. We hope we don't have to get there, but we are doing a lot in that regard.
Mr. President, could you clarify something? These guidelines say stay home if you're sick. Yesterday, the Vice President said no one should worry about losing a paycheck if they stay home when they're sick. But the House bill exempts companies of 500 employees or more from the paid sick leave requirement, and that's 54% of the American workplace. Why is it a good idea to only require small businesses to provide paid sick leave?
Well, we're looking at that, and we may be expanding that. We are looking at that. We want fairness. We want it for everybody. No, we're looking at that through the Senate, because as you know, the Senate is now digesting that bill. So we may very well be adding something on that. Okay? Good question.
Two questions for you, Mr. President. One, going off of what he was asking, how many ventilators and how many ICU beds do we have right now, and will it be enough?
I could get back to you with that number. We've ordered a lot. We have quite a few, but it may not be enough. And if it's not enough, we will have it by the time we need it. Hopefully, we won't need them.
And you'll give us the exact number?
Yeah, we'll be
because
able to
so
give
far
you.
they have not given us an exact
We'll
number.
give you. We can give you a number if it's important. We'll give you a number. Go ahead.
Okay. And yesterday you said that this was under tremendous control. Do you want to revisit that statement if we are going to be experiencing this until July or August, 5 more months ahead of
When I'm talking about control, I'm saying we are doing a very good job within the confines of what we're dealing with. We're doing a very good job. There's been a tremendous amount of the way they're working together. They're working hand in hand. I think they're doing really a great job. And from that standpoint, that's what I was referring to. Yes, Steve, go ahead.
You're not saying it's under control, right?
I'm not referring to it, meaning the. Yeah, if you're talking about the virus, no, that's not under control for any place in the world. I think I read. No, I didn't. I was talking about what we're doing is under control, but I'm not talking about the virus. Yes, please.
The stock market took another hit today. Is the U.S. economy heading into a recession?
Well, it may be. We're not thinking in terms of recession. We're thinking in terms of the virus. Once we stop, I think there's a tremendous pent-up demand, both in terms of the stock market and in terms of the economy. And once this goes away, once it goes through and we're done with it, I think you're going to see a tremendous surge.
Are you looking at any domestic travel restrictions? I know that's been on the table before, but is that firming up at all?
We're not really. We hope we don't have to, Steve. We think that hopefully we won't have to do that, but it's certainly something that we talk about every day. We haven't made that decision.
Can I ask you, doctors and nurses in this country are telling us across the board that they're terrified of this virus, of the fact that they might get it, of the fact that they might take it home to their families. What can you say to assure healthcare providers in this country that the federal government is doing something today to ensure that they get personal protective equipment to protect themselves and their families?
Well, I think the federal government is doing everything that we can possibly do. We made some very good early decisions by keeping people out, by keeping countries out, certain countries where the infection was very immense. I notice a lot of people are talking about South Korea because they've done a good job on one side, but on the other side, tremendous problems at the beginning. They had tremendous problems and great numbers of death. I think that we've done a fantastic job from just about every standpoint. With that being said, you look, no matter where you look, this is something, it's an invisible enemy. And but we are speaking all the time, not only with the people, but also the professional people, the nurses, the doctors. They have been doing a fantastic job. We are also working very much on getting them the kind of equipment that they need. And for the most part, they either have it or they will be getting it. But remember this, We want the governors, we want the mayors, we want them locally from a local standpoint because it can go quicker. We want them to work. And we had a great talk with the governors today. I think it was a really great talk. There's a tremendous coordination. There's a tremendous spirit that we have together with the governors. And that's pretty much, for the most part, bipartisan. Yeah.
Mr. President, you told John that you think this could wash through, as you said, July, August. You just told Steve when he asked you about a possibility of recession. You said it may be. I'm curious, if there is a recession, when do you think that might hit?
Well, I don't number one, determine recession. I just say this: we have an invisible enemy. We have a problem that a month ago nobody ever thought about. Nobody in the, I've read about it. I read about many years ago, 1917, 1918. I've seen all of the different problems similar to this that we've had. This is a bad one. This is a very bad one. This is bad in the sense that it's so contagious. It's just so contagious, sort of record-setting type contagion. And the good part is the young people they do very well, and healthy people do very well. Very, very bad for older people, especially older people with problems. My focus is really on getting rid of this problem, this virus problem. Once we do that, everything else is going to fall into place. Yes, please.
President, a lot of rumors last night that you were going to put in a national curfew or some kind of, texting.
I've been reading. I've been watching.
Right, exactly. Me too. Your people were saying this is a foreign disinformation campaign. Is that what's going on? Are people messing with us on the internet?
Well, I don't know. I mean, that I can't tell you if they are or not. And, I think a lot of the media actually has been very fair. I think people are pulling together on this. I really think the media has been very fair. I think it could be that you have some foreign groups that are playing games, but it doesn't matter. We haven't really determined to do that at all, and hopefully we won't have to. That's a very big step. It's a step we can take, but we have not decided to do it. Jennifer, go.
Mr. President, two things, one on airlines and one on Jeff Bezos. Can you talk a little bit specifically about what you'd like to do to help the airlines, first of all? And then second of all, we heard that Jeff Bezos has been in contact with the White House daily. Can you say what he's been asking for or proposing?
Well, I've heard that's true. I don't know that for a fact, but I know that some of my people have, as I understand it, been dealing with them or with him. And that's nice. We've had tremendous support from a lot of people that can help, and I believe he was one of them. As far as the airlines are concerned, the airlines, we're going to back the airlines 100%. It's not their fault. It's nobody's fault unless you go to the original source, but it's nobody's fault. And we're going to be in a position to help the airlines very much. We've told the airlines we're going to help them.
They want $25 billion.
Well, we're going to be helping. We're going to be backstopping the airlines. We're going to be helping them very much. It's very important.
What do you do about the stock market, sir?
$25 billion for the passenger carriers and $4 billion for cargo?
We're going to be looking at it very strongly. We have to back the airlines. It's not their fault. In fact, they were having a record season. Everybody was. They were having record seasons, and then this came out. And it came out from nowhere. So not their fault, but we're going to be backing the airline, yeah.
The stocks continue to fall today. Would the White House support negative rates?
Best thing I can do for the stock market is we have to get through this crisis. That's what I can do. That's the best thing we can do. That's what I think about. Once this virus is gone, I think you're going to have a stock market like nobody's ever seen before.
People be voting tomorrow, Mr. President?
Mr. President, the other day you said you don't
he'll be back in a second. He'll be back in a second. I think the question that I think maybe John asked about until July, the guidelines are a 15-day trial guideline to be reconsidering. It isn't that these guidelines are now going to be in effect until July. What the president was saying is that the trajectory of the outbreak may go till then. Make sure we don't think that these are solid in stone till July.
Yeah. That would be the outside number. Yeah.
Mr. President,
you've been criticized.
Hold on 1 second, please. Go ahead.
To follow up, Senate Republicans, do you want Senate Republicans to change the package that passed the House last week, even though you
I think they may make it even better. Look, they're working together very well with the House. They're working very much in unison, like the question before. They're working to only enhance it and make it better and make it fair for everybody. And that's what we're looking to do. So we may go back and forth with the House a little bit, but both will be in a very positive fashion. Please.
Yeah, Mr. President,
these new guidelines say avoid social gatherings in groups of more than 10 people. The CDC's recommendations yesterday were for people to avoid gatherings of more than 50 people. What's evolved in you and your team's thinking in just the past 24 hours? And also, what exactly do you need to see in a stimulus
Well, let me
bill?
just have the professionals answer that. Would you like to do that?
Great. Thank you, and thank you for that question. So we have been working on models day and night around the globe to really predict, because some countries in our very early stage, like the United States, we've been working with groups in the United Kingdom. So we had new information coming out from a model, and what had the biggest impact in the model is social distancing, small groups, not going in public in large groups. But the most important thing was if one person in the household became infected, the whole household self-quarantined for 14 days, because that stops 100% of the transmission outside of the household. And as we talked about early on, it's silent. We had another silent epidemic, HIV. And I just want to recognize the HIV epidemic was solved by the community, the HIV advocates and activists who stood up when no one was listening and got everyone's attention. We're asking that same sense of community to come together and stand up against this virus. And if everybody in America does what we ask for over the next 15 days, we will see a dramatic difference, and we won't have to worry about the ventilators, and we won't have to worry about the ICU beds, because we won't have our elderly and our people at the greatest risk having to be hospitalized.
Dr. Burks, can we ask you to comment on the equipment? Doctor?
Go ahead. Yes, Mike, please.
Thank you, Mr. President. Very productive call today with governors. We talked about the new rollout of testing that we described yesterday, and drive-through and community-based testing. And I know how grateful the president is for the efforts that governors are making, and now with the Admiral and the United States Public Health Service as well as FEMA, we made great progress today in coordinating those efforts. But the other issue that was raised with the president today was personal protective equipment. And the reason I mentioned testing is because one of the recommendations that we have for states is that these remote testing sites make a priority of two groups. One would be people over the age of 65 that have symptoms. We don't want them to go to hospitals or emergency rooms. We want them to go to a remote site in a parking lot or at a isolated community location. But the other category is our healthcare workers. We want to make sure that our healthcare workers have the opportunity to be tested, and using that new high throughput test that the president arranged with our major commercial labs, we'll be able to do that much more expeditiously. So we're putting a real priority on our extraordinary healthcare workers that are at this very hour coming alongside people that are struggling with the coronavirus and people that are concerned that they may have been exposed. The other piece is we're grateful that the legislation passed by the House of Representatives includes liability protection for N95 masks produced by companies like 3M in Minnesota, by Honeywell. Literally tens of millions of masks are produced every year for industrial purposes, for construction. But the health experts say they can be used just as readily to protect healthcare workers from respiratory ailments. 3M and other companies were not able to sell those to hospitals, but the president negotiated with the Democratic leadership of the House and Senate. We've added a provision to the bill that will literally, from one company alone, add another 30 million masks per month back to the marketplace. We're strengthening the supply chain, and healthcare workers around America can be absolutely certain that the president and our entire team are going to continue to put the health of America first and put first our healthcare workers across this country that are meeting the needs of the people of our country.
Mr. Vice President, how many test kits have been sent out and how many people can actually be tested?
I think the Admiral can answer that. And you might want to talk about the roving also.
So thank you very much for that. As we talked about yesterday, we're really entering a new phase of testing. At first, we were at the initial phase where the CDC-developed test was only available in public health laboratories in the CDC. Works very well for a few thousand tests per day after it gets running. We're now moving into a phase that the big commercial laboratories with high throughput screening have availability. So as we talked about last week, because of the historic efforts of the FDA, a Roche test, and as the President predicted, a Thermo Fisher test were both produced last week under an emergency use authorization. 1.9 million of those tests will be sequentially into the ecosystem this week. From the information we have right now, 1 million tests are available with all the reagents, everything ready to go, primarily at the reference labs called Quest, LabCorp, and a couple others. Now, it doesn't matter if they're not in your neighborhood, because every day when people get tests, a little white box goes out in front, it gets shipped by an incredible distribution system. The test result and it's electronically reported. So these are available to people nationwide. We expect more and more than 1 million coming on board this week as the reagents come up and as people with the testing capacity validate that in their own hospitals and other places. And in the future, we expect at least 2 million next week and at least 5 million the week thereafter. There are also a whole growth of what's called laboratory determined testing or laboratory-derived testing, where individual laboratories, because of the regulatory deregulation of the FDA, can develop their own tests and start using them. So if you're a CLIA-certified lab with complexity, you can do that. So the point is, testing is now entering sort of what we normally do in the healthcare system, where big labs in a high-throughput basis receive these through normal channels. So that part of it is really underway.
Do you know how many Americans have actually been tested? Do you have a number?
There is a number. I don't have that number because I've been working on setting up this distribution system. So this is where we are. The state and public health laboratories in the CDC are published every day on the CDC website. The CDC gets feeds from LabCorp and Quest, and they get that on a daily basis. What is not being received right now, and Ambassador Birx is fixing, is that these homegrown tests in highly complex labs don't necessarily get reported in the system. However, as we move forward, particularly in the commercial phase of where we are right now, we expect about 80 to 85% of the tests to flow right into the CDC. We know them. That's not good enough for Ambassador Birx. She wants 100, and we'll work on that.
So I think just to put it a different way, a lot of testing has been going on, and I don't believe anybody's been able to do what we're doing and what we will be doing.
And let me just say that we talked about the drive-through testing yesterday. I want it to be clear to everybody, this is just another tool for states and local public health systems and healthcare systems to use. It's not replacing testing that goes on in a doctor's office or in a hospital, or if you go to your doctor and wants to get tested in that office. This is just another tool that we're helping the states to have. And again, as we talked about, this is modeled on the FEMA-based points of distribution system, optimized for testing. We expect this week, we now have gear, people being shipped right now today that will be in over 12 states with multiple sites, many of states having multiple sites, to start augmenting the local capacity and really providing the state and the local people what they need as another way for people to get tested.
So this has never been done before. That's never been done, and certainly not on a level like that. And I will say that I think I can speak for the professional to handle tremendous numbers of people. John?
Mr. President, earlier today, Governor Cuomo of New York said that he believes that hospital capacity soon will be overwhelmed, and implored you to call on the Army Corps of Engineers to build temporary facilities to house patients. Is that something
we're looking into? It. We've heard that. We've heard it from really two places. There are two places that have specifically, New York being one, and we're looking into it very strongly. Yeah. Steve, go ahead, please.
Sir, how have you changed your own behavior to take account of this virus? Are you washing your hands more?
Oh, I've always washed my hands a lot. I wash my hands a lot, probably, maybe if anything more, certainly not less.
What was it like taking the test?
Not something I want to do every day.
You had said that in a tweet that Governor Cuomo should be doing more.
I think he can do more.
What specifically
but I think
should he be doing?
I think he can do more, and it's an area of the country that's very hot right now. I think New Rochelle and a place I know very well. I grew up right near New Rochelle. I think I think it's an area that has to be tamped down even more because it's a hotbed. There's no question about it. So I think they can look at doing it. But we're getting along very well. We've had a very in fact, I noticed he made some statements just now that the relationship with the federal government has been good. The federal government has done everything they've wanted us to do. But we can, I think it's very important that all of the governors get along very well with us and that we get along with the governors. And I think that's happening.
The defense secretary and the assistant defense secretary have decided to separate and be in a bubble to avoid the spread of the disease and to protect the chain of command. Is that something you and the vice president should be doing? And has there been any talk about having to have a 25th Amendment?
Well, we haven't thought of it, but I will say this: that we're very careful. We're very careful with being together. Even the people behind me they've been very strongly tested. I've been very strongly tested, and we have to be very careful. But everybody should be vigilant. We have to be vigilant. Yeah,
Thank you, Mr. President. Two simple questions for you, Mr. President.
Go ahead, please.
Two simple questions for you, Mr. President.
Hold it before you.
Okay, I don't know if this is a question for you or for Dr. Burke, but Dr. Burke said that it is the millennials who are going to lead us through this, and that now is the time to look out for the older people in our home. Older might be a state of mind, not necessarily an age. So for those millennials of us who have parents who are in their 50s, 60s, 70s, what is older? What should we tell them at this point?
Well, if I was Dr. Fauci, I would tell you there's a physiologic age and a numerical age. So older people with pre-existing conditions. And what do we mean by that? Significant heart disease, significant kidney disease, significant lung disease, any immunosuppression, any recent treatment for cancer, any of those pieces in any household. Now, why do I think the millennials are the key? Because they're the ones that are out and about. And they're the most likely to be in social gatherings. And they're the most likely to be the least symptomatic. And I think we've always heard about the greatest generation. We're protecting the greatest generation right now, and the children of the greatest generation. And I think the millennials can help us tremendously by having, plus they need to communicate with each other. Public health people like myself don't always come out with compelling and exciting messages that a 25 to 35-year-old may find interesting and something they will take to heart. But millennials can speak to one another about how important it is in this moment to protect all of the people. Now, you could be 40 and have a significant medical condition and be of substantial risk. You could be 30 and having come through Hodgkin's disease or non-Hodgkin's lymphoma and be of a significant risk. So there are risk groups in every age group, but there's more millennials now than any other cohort, and they can help us at this moment.
Mr. President, thank you very much. Thank you very much, Mr. President. You already talked. Mr. President, the other day you said that you were not responsible for the testing shortfall. Very simple question. Does the buck stop?
A very highly infected country, despite all of even the professionals saying, no, it's too early to do that. We were very, very early with respect to China. And we would have a whole different situation in this country if we didn't do that. I would rate it I would rate ourselves and the professionals. I think the professionals have done a fantastic job. As far as the testing, you heard the Admiral. I think the testing that we've done, we really took over an obsolete system or put it maybe in a different way, a system that wasn't meant to. We broke down the system purposely. We broke it down in order to do what we're doing now. And within a short period of time, and even now, we're testing tremendous numbers of people. And ultimately, you're saying it will be what? It will be up to how many people will we be able to test?
We certainly expect with the high-throughput testing that that's no longer a barrier. The barrier is actually doing the test on a person. And I'm sure, as the president would inform you, In order to do the test, a healthcare provider needs to dress in full personal protective equipment, and there's a swab that's put in the back of the nose all the way to the back of the throat. It's called a nasopharyngeal swab, which is then put in media. The next person who has to get tested, that healthcare provider has to change all the personal protective equipment. When you put that in, it's highly likely a person coughs or sneezes, surgical things too that might be breakthroughs to make it much faster. But we certainly expect that from thousands of people per day, we will be at the tens of thousands of people per day this week, according to those who are.
Does the buck stop with you, Mr. President? Does the buck stop with you?
Yeah, normally, but I think when you hear the, this has never been done before in this country. If you look back, take a look at some of the things that took place in 09 or 11 or whatever it may have been. They never did. Nobody's ever done anything like what we're doing. Now, I will also say, Admiral, I think we can say that we're also getting this ready for the future so that when we have a future problem, if and when, and hopefully we don't have anything like this, but if there is, we're going to be we're going to be starting off from a much higher plateau because we were at a very, very low base. We had a system that was not meant for this. It was a smaller system. It was meant for a much different purpose. And for that purpose, it was fine, but not for this purpose. So we broke down the system, and now we have something that's going to be and is very special and is ready for future problems. I think we can say that very strongly. Yeah. Go ahead, please.
Taking place tomorrow. Is it your advice that those states postpone those elections?
Well, I'd leave that up to the states. It's a big thing, postponing an election. I think, to me, that really goes to the heart of what we're all about. I think postponing an election is a very tough thing. I know they're doing, because they've been in touch with us, it's not a very good thing. They have lots of room in a lot of the electoral places, and I think that they will do it very well. But I think postponing is unnecessary.
On the northern border, sir, how close are you to shutting?
We think about it. We think about it. If we don't have to do it, that'll be good. We have very strong emergency. Right now, we have not decided to do that, Steve.
Can we get Dr. Fauci to talk about the vaccine trial today and whether the timetable for vaccine is it possible to accelerate, or is it still 12 to 18 months?
2 to 3 months, and if we did that, that would be the fastest we've ever gone from obtaining the sequence to being able to do a phase 1 trial. This has been now 65 days, which I believe is the record. What it is, it's a trial of 45 normal individuals between 28 days. There will be 3 separate doses, 25 milligrams, 100 milligrams. 250 milligrams, and the individuals will be followed for 1 year, both for safety and whether it induces the kind of response that we predict would be protective. And that's exactly what I've been telling this group over and over again. So it's happened. The first injection was today.
Sir, the market just closed down 3,000, almost 13%. Your response to the market close, sir?
Is pregnancy an underlying condition?
Dr. Fauci, is there guidance for someone who may have felt sick but then feels better, so you had symptoms but you no longer do, your fever's gone away, how long would you stay home after that point? That's not clear from the guidelines.
Well, if you are positive for the infection, if you have coronavirus, it is less how you feel than whether or not you're still shedding virus. So the general issue about letting people out of a facility, who, for example, a hospital or whatever, who have been infected, you need 2 negative cultures, the same way that was just
very strong as soon as we get rid of the virus. Yes.
Could you clarify?
I said the reports that came in from China, from the Chinese CDC, of the 9 women who were documented to be pregnant and have coronavirus in their last trial from countries. While countries are in the midst of this crisis, like Italy, I try not to bother them frequently to get us their data. We try to get it just weekly from the countries that are in the midst of responding to the epidemic so that their focus is on their individuals in their country.
Mr. President, any comment on what people like Devin Nunes, the governor of Oklahoma, have been saying, encouraging people to go out to restaurants, which goes directly against what this advice in your guidelines says?
No, I haven't heard that. I haven't heard that from Devin or anybody else.
Should they stop saying that?
Well, I have to see what they said, but
They encourage people to go to restaurants if they felt okay with their families.
I would disagree with it, but right now we don't have an order one way or the other. We don't have an order, but I think it's probably better that you don't, especially in certain areas. Oklahoma doesn't have a tremendous problem. Oklahoma, you said the governor of Oklahoma.
Oklahoma, Devin Nunes
And
is
Devin.
another.
Yeah, well, I had
you.